so that you take informed decisions. Right? Now, you probably, the trust on your father is there so much that you have accepted his decision.
Yes.
Because it is trust. But in other words, you believe that your father is better informed
Yes.
than you are.
Yeah.
So, you believe your father will take an informed decision better than you. So, all our ability should be to take that informed decisions in our life. Okay, whichever field are you from, but having knowledge of finance will help you in taking that informed decisions. You may not be a specialist in finance, right? But if you know that, okay, this is an area where I need to contact a finance specialist and take their inputs, that's sufficient for an entrepreneur, because entrepreneur will not have complete knowledge. And you can only grow so far if you are an individual. If you want to build an organization, then there have to be collective minds working. And each of these minds, if they are specialists, then there will be a synergy effect, right? So, but having a basic knowledge of finance is very, very important for anyone. And we always have that basic knowledge if you are raised in a family, right? If you go for shopping, or intlo probably your mom says go and get something, right? What they will do? These days probably they are giving you a credit card or probably Paytm. So they are giving you fund, right? So you are sourcing fund and then you are buying things. You are expending it. And then once you come back, your parent will ask you what is the balance. You say this is the fund you gave me, this is the expenditure I made, this is the balance. Should I retain it to you or should I retain it for my pocket money? Or probably you'll include I bought an ice cream or I did this, that, and then we'll make a balance sheet there, right? So there is finance inbuilt in our upbringing itself. We are just unable to connect it from an organization point of view. So the essence that I try to bring in today's session is to connect the dots from a layman's point of view. So decision making is very critical for anyone's growth. So our endeavor is to accumulate that knowledge piece and understand, okay, how this decision making process is. So a lot of times I've interacted with a lot of kids who did engineering, who did their doctors and everything, because they say I'm passionate towards it, right? But after 5 years, they may change the course correction. Then when I ask you, why did you change? It was something else then. I understood the reality. Now this is what it is. Like a lot of people go to the US, right? No matter whatever background they go from, they land up in an IT job. Because that's where money is, right? So all the upbringing, all the graduation knowledge that they put in may not be of much relevant to what they do on a day-to-day basis. But the knowledge that they acquire will come into fore while they are executing that personal job. It will have a different flavor, right? So let's try to get that. So what are the critical things in decision making? Every day, in and out, we make a lot of decisions, right? So what is tough in decision making? Toughness comes in when there is a conflict, right? When you have to choose, then you will evaluate, right? So I also would like to share a concept called advantage, disadvantage, and disadvantage and an advantage from my own life. As I told you, from my earlier life, I was born into a business family where finance was not a constraint. Okay, so whenever I wanted to start a business, the last thing that came into my mind was, how do I raise funds? Because I know I can go on to my father and he will give me money to run this venture. So I didn't evaluate properly whether the money that I'm taking from my father will earn the right return or not. The reason I started a mobile food, the reason I started a guest house, the reason I started a co-working spaces, if today I had a constraint in raising capital, probably I would not have started that venture, or I would have handled that venture in a different way. So if any one of you are not having the constraint of finance and you want to get into entrepreneurial role, put that constraint. Have that constraint in mind. Say that, okay, this is my idea, great idea, but I don't want to ask my parents the money to run this idea. How do I still run this idea? Then you will really start evaluating, because you go to someone and say that I have this great idea, can you invest in it? Then people will ask you a different question. How much return I will get? When you will return this money? What guarantee will you give? Right? At that instance, you may feel very bad about it. Hey, this guy is a friend of mine. This guy is a relative of mine. Doesn't he trust me? Because that's what I felt when I asked my father money for some venture. When he was running low, he said, I can't give you. Then I said, man, my father is not trusting me. That's the first thought that came into my mind. But today, I feel so blessed that he did it at least at that point of time. Because hadn't he said that, I would not have learned the lesson. And the KPO business that I did, my investment was close to zero. My investment was my time, my investment was my effort, my investment was my brain. So it is important that you put a constraint, especially when you want to become an entrepreneur. You are with a lot of comfort zones, so assume that you do not have a comfort zone and you start afresh with limitations. And that's when the decision making is important. That is when choice happens, right? Otherwise, choice will never happen. You think that you are blessed with everything, this is de facto thing. So decision making often involves navigating conflicts and trade-offs. By trade-off I meant, today you are all attending this workshop, right? So you need to evaluate, okay, my next 3 years, is it important attending this workshop or not? There is no constraint as of now, right? You put in a constraint. There is some opportunity elsewhere where there is an investor coming in. Will I still be attending this? Yes or no for you, right? Then probably no. Then put in another things. Okay, can I read a book? Can I do some market research? Yes. Why should I go there? So put those constraints and then take a decision. Life is all about taking decisions. As an entrepreneur, you need to take decisions all the time. You need to challenge yourself or remind yourself that your primary role as an entrepreneur is to take the right decisions and put the necessary conflicts and trade-offs at every single point of time. Otherwise, very quickly, the brightest of the idea can become a biggest failure. Okay? So what are the common type of conflicts? These are very generic, right? Good and bad. Remember that there is no categorization of good or bad. Everyone would have gone and blackmailing. We all want to be an entrepreneur, right? We all want to make money. The easiest way, I kidnap someone, make money. That is again another legal or illegal, right? I can do a lot of things. But again, good or bad is a judgment. I want to earn the money the good way, not the bad way. That is a constraint that we have to put in. And risk and reward. This is another constraint. It could be as simple as attending this session. What is the reward I am getting? What is the risk that I am having? You need to have that constraint. Plug in every decision making. Ethical versus profitable. Right? A lot of people do business. A lot of people earn crores and crores of multi-X profits. But do you want to be ethical or not? A Tata company is looked at in a different way. I'm sorry if I can take names. A Reliance or Adani is not looked at the same way as a Tata company. So how do you want to earn that money is equally important. So put that into your thoughts, right? Legal versus illegal. These are some of the generic things probably based out of the value systems, but there are a lot of challenges, right? And for people like students, careership, engineering, management, right? An entrepreneur or an employment or an Infosys or a local startup. These are all the decisions that we have to take. So once you put a constraint, then you will evaluate. In the evaluation process, you list down all these things and then you decide. Once you decide that, then there is an ownership. You are owning the decision. So when you are owning the decisions, you realize that good or bad, I am only responsible for it. Once you get that ownership interest, then you'll stop complaining, because you cannot change something that is external to you. We are all small people, right? We cannot influence a policy. We cannot influence even our father's thinking. We cannot influence our friends' thinking. But what we can influence is probably what's in our mind, what efforts that we can put in. And that comes in only through ownership of the decision. So put a constraint, take an informed decision, and own your decisions. That's important. That's the mantra for success. Now, one of the important decisions for an entrepreneur is to start or not. Right? You have a great idea. You have a great idea of soap, right? Yeah. Whether to start or not. You probably have did a lot of math or anything. Then you need to arrive whether to start this business or not. So you need to think through what are the constraints, right? So what is the decision involved? Should you turn your idea into a reality and launch your business or not? Is the main decision any entrepreneur faces. And the importance of this, because this is the foundational choice that sets the stage for all subsequent decisions for you, right? Once you start it, you decide to get into it, then a lot of decisions in life depends on this fundamental things. So how do you make this decision? One of the important consideration for us to put in is the financial consideration, right? This is the constraint that we need to inculcate. So you need to assess what are the startup costs, what funding options you have, and what is the potential profitability. This I did put in when I started my earlier business, because I thought that that's not a constraint at all. I can go and then ask my father, okay, 1 lakh, I need to run salaries next month. He said, okay, go ahead. I don't know the pains of that. But if he said that no, then probably when hiring a person, I will think whether I can pay salary or not. Hiring an office, I will think whether what sort of office is there required. So here, finance is very, very important. And then you started a business, right? Then there is another decision that you need to take, whether to grow the business or not, right? So you need to have a growth strategy. Whether you want to run the way it is coming, assuming that you continue a business if it's making profits, right? But at some point of time, you need to take a call, whether I should allow it like this, or whether I need to do an external influence so that I can move from X turnover to 2X turnover, or 10X turnover, or 100X turnover. So what is my growth strategy? So why is it important? Because it impacts revenue, it impacts your market reach, and scalability of business. You cannot grow business like that, right? Like, let's take an example of Sairam Parlor in Vizag. I don't know how many of you have seen it growing over the years. It started off small. So he probably could have run it the way it is. First to start, there was Ravi Shankar Parlor at that point of time. I don't know whether you are aware of it. So that was doing roaring business. That was during my college days. So starting at that point of time was itself a tough decision. Started off, and then probably after some point of time he thought of growth. Then probably from a rented premises he moved to an own premises, and then probably expansion. At every 2-3 years intervals they are thinking of grow, right? So that's an important stage. So how do you take a call whether to grow or to remain where you are? There is a financial consideration also which helps them to take the decision whether to grow or not, right? How do you do that? You have to evaluate costs, you have to evaluate risks and the expected returns, financial projections guide you to your growth strategy, right? Whatever the two gentlemen spoke about you yesterday is very relevant. Until and unless you know that, okay, I need to do a financial projection. If I am planning to expand, if I am borrowing, what I should do, whether I can give that return or not, is something very relevant. So it's very important for you to get the knowledge of finance in order to plan your growth strategy. And then this is another decision will be encountered with. You start a business, it's not growing, then you have to decide whether to drop or continue or diversify, right? A lot of people do that. So when faced with the challenge, should you persist or pivot is an important decision. Adaptability is crucial for survival. We have seen how people adapted. COVID was hit badly into our lives, but it hit the business, it hit the countries in a bigger scale, right? But the companies and the country adopted to, at that point of time, it was just survival. They are not thinking of growth or anything. They just wanted to survive that critical phase of life for a company or an individual. But once that phase passed out, they paused a moment, they took into the learnings from this, and today a lot of companies operate in a different fashion, right? So that's an important thing. So you have to adopt and make amends. And what are the financial consideration? Cash flow, assess viability, and adjust course as needed. You probably have heard about the terminology like cash flows, right? Profit and loss account you probably have heard. Balance sheet you have heard. Cash flows is something normally people don't talk except the finance guys. But cash flow statements are very, very important for any entrepreneur. Cash flow is nothing but when the fund is coming in and when the fund is going out, in simple terms. And then resource allocation is another important issue. The resource could be finance, the resource could be people, the resource could be capacity, whatever it is, right? So how do you allocate a resource? How do you take a call? Just because you like a person, you don't ask a person to sit here in a conference room, right? You need to evaluate what is the return you are asking this person by giving this conference room. Is there a better thing that you have to do? So how do you allocate resources, be it time, money or talent? Talent is another important thing. These days, I mean, one of the challenges that we are facing for our successful venture interview buddy, the founder who has been doing a lot of work, the founders of the company work, they probably eat, sleep, dream everything about the company. So the 24 hours itself is not sufficient for them. So they do so much of work that it's important for the investors to free up their time to identify which works of them can be removed from their kitty and can be replaced with alternate people. That's when the need for a co-founder or the senior resources come. And if you probably look into it, whenever there is a financial intervention in a company, which is in the form of angel investment or a venture capital funds, it is not just for money. People go for partnership with these companies. They also go for getting the right talent, right connects. You were saying about connectivity, right? So if you probably connect with an investor in your space, right? He can quickly take your product to different markets with less time. Though you might have the finance to fund your activities, but if you're finding an investor with that sort of a network, that would be an ideal partner for you to call in for investment. So the talent is very important. So we are all born with a finite talent. We are always trying to expand. But we need to work with multiple talented people to acquire the larger objective of making most of an enterprise. So efficient resource allocation and maximizing productivity is an important decision that you have to take. And the financial consideration in this is you have to do budget, you have to cost control, and then prioritize. Assuming that you have only 1 lakh of rupees and there is a requirement of 3 lakhs, that is a constraint that you need to put in and decide where you want to spend this 1 lakh. If that constraint is there, then you look into and say that, okay, if I invest in raw material, probably I can get a 20% return of it. If I invest in a computer for my person, I don't get anything. So but computer is a required thing, right? So instead of buying a computer, probably I can lease a computer. So buy or lease decisions come because of this efficient financial allocation. It's not that people, in earlier days, people used to do business by first buying a land and then starting a business. The American way of doing business is everything is on lease. You heard about pink slips, right? Even people, they are fired. Onboarded fast, fired fast. Places, they get into it, and if they want to wind up the business, they do it in 6 months. They don't want to be tagged to a particular business. Their entry and exit, they want to make it easy because all the money that they have, they want to invest in sales. Sales because it generates profits and it creates wealth for them. So resource allocation is very important. And for that, you need to do budgeting. You need to understand about cost control and then return on investment. That's an important element. And then pricing, product or service pricing. You're talking about it, right? You want to divert from a service market to a product market. Service market is always cost plus your profit, right? You know what your cost of that service is. You probably decide on the profit percentage and then do. But once you're developing a product is, there's a lot that goes into a product, right? How do you price it is an important issue. How do you want to recover that the money that went into your product? And especially in an IT product, what you started off today will go obsolete very soon. So there has to be versions of it. There has to be updates for it. So the product upgradation is a continuous process. So your product pricing is very important. So there are different pricing mechanisms. So that's an important decision. So set the right price for your offerings. So you need to understand that the pricing affects your revenue, competitiveness, and customer perception. Just because your price is low or your cost of delivery is low, if you price it low, probably it will not appeal to all markets. Some products are priced to catch the attention of elite customers because they want to put it in the niche. Apple, you see, Apple phone is priced at a premium customers. They intentionally price it more because that's the market that they want to attract. And if they are decided that's the market they want to attract, then the brand they create, the marketing thing we have talked about in our earlier session. He said they position it, owning an Apple phone is a brand by itself. So that's how you do it. And what is the financial consideration? You need to understand costs, you need to understand the market demand and competitive landscape. And all this needs a lot of financial knowledge to arrive at this informed decision. How much you need to price for your product or how much you need to price for your service. And then investment. This is the very critical thing. It could be the initial investment or the later on, once the company is making a lot of money. What do you do with the surplus? Do you distribute it to your partners or shareholders? Or do you want to reinvest in the business? Or you want to reinvest in other businesses so that to mitigate risks? This is another important decision. So investments impact growth and long-term success. I mean, there are ways of wealth maximization and value maximization, especially that came into light after 2000. You heard about GE, right? General Electric, and the outsourcing model. So why they started outsourcing? Because of what I started earlier, faster, cheaper, better. So they opened offices across the globe because they wanted to get that benefit. And there is something also called as disaster recovery planning. Because if you concentrate everything in one place and God forbid something happens, the service disruption will happen. So as you grow, an organization need to plan for continuity of service. Because at no point of time you cannot say, if you're starting a restaurant, you cannot say that today I cannot deliver because my cook is absent. You need to consistently deliver the same items to the same taste. So probably that's why you have a backup. You probably have a main cook. You'll also hire an assistant cook who will slowly learn how to cook and maintain the same quality. Similarly, what GE did is GE started different centers across the globe. And then over the period of time, they realized that this is a good model. So they broke it down into different companies. And each of these companies created a lot of value by itself. So that's how the company, though General Electric company started off with some business idea, for every specialization they made, they broke it into different companies, and now they are a conglomerate into specialized activities. Similarly, Tata's, Reliance, you name these companies, they start with one purpose, they grow it, and then they look for how to make it an independently separate business unit and create value for the shareholders. So this is all part of the investment decisions. So where you invest your capital, how it impacts growth and long-term success. So what is the financial consideration involved in it? You have to evaluate risks. Whether you want to invest in land, whether you want to invest in marketing, whether you want to invest in technology, whether you want to invest in brand building, or whether you want to invest in people. These are some of the things that you need to do. And then when you are putting that constraint of capital and an ROI as an element, some could be tangible returns, some could be intangible returns, right? Tata's, what they've done for their employees in the COVID period, or for their vendors. During COVID, Tata's has a lot of spaces across retail stores, right? During COVID period, a lot of companies went to their landlords and said that we are not going to pay rentals for the COVID, during the COVID business. Or they went into bargaining. I gave my property to Paytm. They said that they won't pay me rent because they didn't have business to run. Whereas Tata's, even though they had 10,000 or 100 lakh square feet of business, they paid that. Because at that point of time, it is prudent for anyone to go and bargain. But they wanted to be recognized for a value-based company, right? So financially, the ROI, the tangible return may be not right, but they were looking beyond that. So once you are aware that, okay, these are the tangible returns, these are the intangible returns, so probably I'm aiming for that, that is fine. You take an informed decisions. Not that all our decisions will be correct, right? It will be correct at that point of time. Later on, it may be failure, but at least it will help us take the ownership of the decisions, right? It was me who took the decision. And then alignment with the business goals is an important aspect, right? This is something that people need to invest. And then probably yesterday's sessions, you might have heard about compliance, right? A lot of startups, a lot of businesses, even when I started my business, compliance was the last thing. As I told you, I was looking for tax-free income. So one of the things is, okay, no compliance, nothing. I need not worry about the income tax guy or anything. And then whenever there was a way out, without bill, food business, cash. When you report at the end of the day, I said, okay, you have to pay 20%, 30% tax. No, cash is fine. Right? But today it's a different thing. And I come from a business background, where I used to take pride in bribing people. Let me be very honest. We bribe everyone, right from the CEO to the downline. I used to take pride in it. But today it's a different scenario. The value system has moved up. You are okay foregoing, but go by the rule book. So compliance is a very important aspect that all the entrepreneurs need to have it in their mind, right? Especially this generation which is in transition. Next generation will be used, they don't know, because everything is digital now, right? Everything is accounted now. But still there is a transition phase, there is still some cash going on. For the next generation, it will be completely like US. But even in US, this time when I went in, I was surprised to see in some Indian restaurants again. They said, you pay in cash, we give you a discount. So we know how to make systems work in any place, even in the best systems. That's why we are a strong entrepreneurial mindset. So legal and regulatory compliance is important. So why? Because there is a cost of non-compliance, right? We heard big companies, big individuals going to the docs. Satyam. I mean, we all have to be very grateful to Satyam for the recognition that they have given to the Andhra community, right? But because of some non-compliance issue, the person who started it is facing the music, right? Probably he didn't factor it, or probably he thought that, okay, there were some other compulsions, he took it. So those are the things that you need to be. And why? Compliance ensures business continuity, which is very important. So there is a cost of compliance, whether you want to be compliant or not, while you are mentioning about the standards and compliance. Very important. You start a product, you have to know what the standard is, because tomorrow you don't want to be hit back with someone saying that, hey, this is what it is, and there is a litigation phase. And then, so you understand your tax obligations, the licenses requirement, and the contracts, right? And whenever you talk about all these things, there is a finance component. So financial knowledge is very important. Even as an individual, forget about an entrepreneur, right? You are working in a company, you want to do a lot of activities, try to be compliant. You file your income tax returns properly, right? You own a property, pay your taxes properly. Driving license, pay your challans properly, right? So you don't know when it will hit you. You may think that you will probably escape, but again, you never know when it will hit. But again, in business, there are a lot of times when you have to walk the tightrope, right? So, like for instance, TDS. You heard about TDS?
Tax deductible and source.
Tax reduction at source. So whenever you are making some payments to your vendors beyond certain amount of time, amount of money, you have to deduct certain percentage depending on what sort of payment it is. Okay, it's your obligation. If you are not willing to deduct that amount, there is a penalty, right? When there is a cash crunch, a lot of finance managers, they do that. They know that, okay, it is, they have to deduct the TDS and they have to deposit it. But they probably are not getting the money at the right time. So they evaluate it and say that, okay, I am willing to pay that penalty fees and use this fund for some other emergency, right? And they still do that. So financial planning, tax planning, all comes from the fact of being aware of the lot of way outs that the government has provided and the costs involved in it and the criminality involved in it, and taking the right decisions. Okay, once you are aware of it, then hopefully there will be continuity as an individual, continuity as a person. And then cash flow management, this is an important aspect. Why? Again, you know, you need to have an idea about when you need money, right? If you have to know when you need money, you need to decide when you have to make payments. Let me take an simple example. You are starting a company, like for your, let me take the example, soap company, right? You have to buy a lot of raw materials. So you buy a lot of raw materials, you do some process, you sell it. You sell it to retailers, right? If you are going to sell to a shopkeeper, till you establish a brand, is not going to give you any advance. He will only say that he will make payment after he sells the product. So if you have to produce, you have to distribute it to him, and you have to wait for the sale time, and then there will be a collection time, right? So your money is going to come after the completion of all this cycle. But for vendors, for when the time of procuring your raw material, the raw material guy may ask you upfront payment. So if you have put in a financial constraints, what you will say? I'll pay you 10% advance. I'll release 30% after 30 days. I'll probably release another 70% later on. Right? He may agree or not, but at least the thought will come to you. Okay, why? Because I need not start with 1 lakh rupees. I might start with 10,000 itself, if I plan my payment policy. Or vendor says that no, I need 100%. He will say then, okay, you give me 100%, I'll give you a 10% discount. If you go into a negotiation mode, the 1 lakh, then probably he'll say that I'm happy giving you a 10% discount, give it to me 90,000. So you got a 10% once you have put that constraint. And then you will decide, okay, I'm getting my raw material, but I need to collect this money fast. Instead of retails, I want upfront sales. How do I do it? Online sales. Online sales, people pay and then you deliver. That's a model. So probably you will say my MRP is 100 rupees. I will give it to you for 80 rupees. You offer a discount because you are getting cash in your hand. So you time your inflows, you also time your outflows. That's very, very important in any business. If you are not planning that, then you need more money than required for the same profit. So cash flow system is very, very important. So cash flow issues can disrupt operations. This is very, very important. You have seen a lot of companies, they probably find it very difficult to run through, especially the seasonal things, right? In a seasonal business, there is a lot of peak sales in certain point of time and then the sale drops. But you need to plan your income and expenditure accordingly so that you can survive the entire season. So for that, you need to have a proper knowledge about cash flows. So what are the considerations? What accounting tools you need to use to know your cash flow projections? You need to create projections and you need to have liquidity plans, right? I mean, if you are not aware of the cash flow requirement, then probably you'll not even think about an option called as bill discounting. There's something called bill discounting. Have you heard about it? Yes.
So the companies will give, like banks will give a loan on a tax, like on an invoice basically, or a purchase order. So the capital required to fulfill that particular order will be given by the bank. Once the order is fulfilled, money will be transferred back to the bank.
Yes. At the end of the day, instead of starting with 1 lakh, again probably you can start with 10,000. If you're giving it to a branded name, I'm supplying my soaps. Again, I'm sorry if I'm taking that. Just trying to play the concept. The same luxury soaps, you are giving it for the Tata Hotels. Tata Hotels has given you a work order for say 10,000 soaps a month, right? They say my payment is 45 days after delivery. But if you have a work order, you go to a bank and they say that I have a Tata work order for me. Can you give me upfront money? They'll say the value is say 1 lakh, I'll probably give you 50,000 or 60,000 at 8% interest or 10% interest. So instead of you starting with 1 lakh, you can now think about 50,000. So you need to be aware of how to do that, right? So these are, and there are now specialized people who are doing this bill discounting, payables discounting, funds being made available so that you can plan your inflows and other things. So this will help you in managing your liquidity. So this is the reason probably I did enough of sales talk to emphasize the importance of finance, right? So in this backdrop, try to evaluate all the things that you want to do in life. Probably this one. I think we touched about it, whether to reinvest or Yeah. If your organization is making a lot of profits, right? How much of profits you want to reinvest in the same business, how much you want to distribute is another important decision that you want to take. Because reinvestment may have to be invested to fuel growth or to meet some future contingencies. Otherwise, it's better to reinvest them elsewhere. So balanced growth needs with shareholders' returns, because a lot of people invest in a company, they expect some return. So you have to return to them, but you cannot return all the profits, because tomorrow there might be a situation where you don't earn profits and you have to raise funds again. So if you are making X profit, then probably 20% of the profits can be distributed, 80% will stay in reserves and surpluses, so that they will be useful for your future investments or any contingencies that they have. So these are all you'll get to know if you have knowledge about finance. And very important, exit strategy. The whole startups got fancy of it because of this exit strategies, right? Today everyone wants to be an entrepreneur because we know he made 100 million, he made 20 million, he made 1,000 million. Gone are those days when business are started for a lifelong activity. Everyone now wants to start a business because they want to exit. So when you want to exit is an important decision one has to make, right? Because you don't want to live with the same idea for long. So when we are touching about the funding aspect in the later part of the day, I'll also talk about the exit strategy and how, you see, as you grow in an organization, people will start investment. So your stake in the company reduces, but you'll still make more money, right? Because that's the way about it. So how and when to exit is an important decision. So plan a profitable exit or a long-term sustainable strategy. And then you need to understand the valuation, acquisition, which route to go, or an IPO, what are the different options needed. So for all this, knowledge of finance is very, very important. Why? Because decision making, if it is done with the help of data, it is more authentic. One of the important lessons that I learned in my corporate tenure when I was part of the multinational company is anything that cannot be measured cannot be improved. Managed for once, but why do you want to manage it? It's only for improvement, right? And if you look back, we are measured always. You go to school, you are measured by your marks or grades. Your absenteeism is measured, right? Your wealth is measured, your waistline is measured, right? If you want to control it, you have to measure it. Increase or decrease is a different thing. So otherwise you can, I want to be rich is an abstract statement. I want to be rich by 10 million by the time I am 30 years old. You are putting a measurement there. And every year you are measuring how close you are. The 10 million you can revise it to 1 million or 100 million depending on the progress you are making. But if you do not put the 10 million as a measurement factor, you will not get the right direction. And you will not get the right evaluation of time. So for all the people who want to, in the switching roles between an entrepreneur or an employment, you put some metrics. So this is what I want to measure myself. And then if I achieve it, I'll probably make a course correction. Because if you want to be an entrepreneur, you probably need to have your own funds. Your own funds gives you the ample flexibility to take decisions without interference of others. So you decide probably once I have a bank balance of so and so, I'll become an entrepreneur. How to get that first bank balance is a different story. You want to get it from your parents, you want to get employed and then work, or do something else is a different thing. But that's required, right? So those sort of measurements is very important. And finance helps you taking the data-driven decision. And financial literacy enables objective, measurable choices about products, services, or businesses that we get into. Strategic thinking. What is strategy? Strategy is something long term, right? If you have to think long term, then you need to have all the bits and pieces of information, and you need to clearly have a blueprint of how you see yourself over the 5 years or 10 years of life. The common questions, if you go into any interview these days, they ask you, what is your long-term career plan? What is your short-term career plan? Why do they ask? And everyone says the same thing, okay, I want to become this, I want to become that. Because they don't give a lot of thought to it. They want to see whether the job that someone is being employed is in direction with which what they want to achieve. If that is not there, then probably employing a resource will not give you the right value. So you need to be very clear. And for an enterprise, if you're starting an enterprise, there are a lot of people involved. You need to have the ability to take strategic decisions. So for taking strategic decisions, financial insights give you a lot of help in identifying the right opportunities. Because if you have 1 lakh of rupees, you have 3 ventures to start. Which one do you start? Your heart says that, okay, I want to start a venture wherein I can sit in an air-conditioned room and talk to intellectual people or good-looking people. That's what your heart says. But when you go to a finance guy, he says that, okay, if you do this, your money will be wiped off in 10 days. What's some other business? You have to go and work in the sun. But this gives you 10x returns. Okay, then you'll say, oh, this is what it is. Then you take an informed decision. So that is what is very important in the finance as an aid can help you. It will help you identify opportunities, identify threats, and it will help you take decisions in a guided way, in an informed way. Okay? So this is the end of the first session about the importance of it. So the second session is just to test your knowledge.
What we have learned yesterday.
What you have acquired from yesterday's session. Okay. So, do you want to take a break?
Yes.
Please. I want to take a break. So this time there will not be much of talking from my side. Slides which I want to share is primarily explain the fundamentals of financial statements for dummies, non-finance people. Okay? So how do we arrive at that 2 financial or 3 financial statements is what I want to talk about. So first of all, the important aspect that we all should understand whenever we are starting an entity is the entity is different from us. Right?
Yeah.
It's like you giving a birth to a baby. Right? Incubation is something that happens when a baby is in mother's womb. Right? You start thinking about it, how my baby is, when it is going to come out, and all that information. But actually the day the baby comes out is the date when a new enterprise is born. So the baby will have a new identity. It has got his own eyes, nose, ears, life, name, which is separate from his mother. Right? Similarly, any business that we start has to be treated as a separate entity. You might be the sole owner of it, that's fine. It's all your ownership. You might own 100% of it, or you might own 1% of it. But that entity is separate entity. You are just an investor, or you are an executor, or a caretaker of that entity, depending on the role that you play. So first point we need to remember is it is a new entity. And as a founder of a company, we need to ensure that the entity continues beyond us. Like a parent thinks. Parent will never think that, okay, I'll only take care of my kid till I am alive. Right? The parent is feeding, doing and all the activities so that the kid will have a life of his own. And at a later stage, probably the kid will take care of the parent also, and along with the parent, it will also have its own family and then play a larger role. So that is the clarity that we need to imbibe. It's a new entity. So it is separate from me. I am Kiran. I am starting a student entrepreneur business today. I am putting 100% money, time for this business. But the student entrepreneur business, I have to find a name for itself. That is a separate entity. I am contributing it now. Tomorrow I might get a lot of other people coming in, and then I might leave this company. Someone else will run this company. There will be a lot of employees who will be run. So that company's life is different from my life. That is the first thing that we need to think. So when you think with that mindset, then remember TiE. Okay, this is how I got grasp of accounts and finance in my life. Life is all about TiE. TiE. Okay, this is one line and this is one line. Okay, and there is another TiE.
Yeah.
Two T's.
Two T's.
So first T, if you call it a balance sheet. Okay, and the second T, you call it profit and loss account. So when there is a new entity, whatever is coming in, whatever is going out, will come under these two statements. Because there is T, there are two quadrants there, and there are other two quadrants here. So it goes into these four things. That is first rule. Second rule is, if you are putting any entry in left side, there has to be a correspondent entry in right side.
Balancing.
Right? So double entry. Any transaction will always have two parties. One the giver, one the receiver. Right? So likewise, there is two entries. Either it goes into the left side of the balance sheet, then it has to go somewhere on the right side of the balance sheet, or it can go as a profit and loss account, or whatever it is. There is an impact. So accounting is nothing but recording transactions appropriately so that it goes into these four pockets. Right? Why we have to do that? Because there are certain standards that have been set by the government. These are called accounting standards. Every country framed with their own accounting standards. And then when globalization happened, there are subsidiary companies, holding companies across borders. So then there was a need that was felt that all these accounting standards need to be standardized into one format. Okay, so there are also global standards in accounting. They call it US GAAP or whatever it is. So they've also tried to evolve. Okay, wherever it is, we will classify the different financial transactions or accounting transactions under different heads. And where each head has to go will be defined by different accounting bodies. It could be in balance sheet under the assets, it could be in liabilities under shareholders' money, or it's an operating income or an operating expenditure. There are different heads. They are grouped. Okay, that's all the job of the accountants. They know, okay, depending on the type of the expense, they know where to group them.
So it's like chart of accounts.
Chart of accounts is the list of accounts. But chart of accounts are grouped under certain categories.
Expenses and
Yes, likewise there are broad categories. So each of the balance sheet has different groups. Each of the profit and loss account also has different groups. So if you look at, as a layman, the first thing, if you want to understand the finance, pick any company that you want. Look at their profit and loss account. Look at their balance sheet and see what are the different heads are. Suppose you are planning to start a product company, sir. So you pick up a product-based company. Pick their balance sheet and profit and loss account. Look at that. You will get different heads, right? In profit and loss account, there will be some expenditure, there will be some income side. Similarly, in their balance sheet, there will be some assets, there will be some liabilities. Just go through it. Then you will get an idea. Oh, okay. From that itself, you will probably know that okay, by this way can I raise revenue? By this way can I raise capital? Those are the thoughts that will come. Like for a product-based company, subscription-based is an important model.
Yeah.
Right? Earlier, what Microsoft was doing, MS Office license.
Standalone license.
Standalone license. You buy it, use it for lifetime. That is tagged to a system. Right? You pay for they used to stick a sticker on the system and they say use it. People used to copy it and then they used to adopt it to different systems. But these days, what they are doing, they're not giving the ownership of the product to the end user. They are giving user licenses. You do not own a Microsoft Office or Word. You can use a Microsoft product for a month or a year or lifeline based on a subscription. So whenever a product-based company you're planning, then for your pricing strategies, you probably once you look at their profit and loss account, then under income heads, there may be revenue from subscription, right? There may be different heads. Those may give you insights into what are the sources of income that you should be targeting, how you should package your product. There will be AMC charges, right? So there could be something else, or what do they call it? Installation charges could be a line item, or then probably configuration. The same product, if they have to configure to a particular organization, the setup charges. Setup charges could be an income source. So the awareness of the profit and loss account and balance sheet gives you those insights into planning your product pricing strategy. Okay, so just to recap for the people who just joined, what I was telling you is I'm trying to break down the finance and accounting into simple terms, which is finance and accounting for dummies. And the way I look at it, accounts and finance is nothing but two T's. Basically, you heard about balance sheet, there is a profit and loss account. So if you consider this as a T and this as another T, first T is called as balance sheet, second T is called as a profit and loss account. So whatever expenditure, income that's coming into the organization has to fall in one of these pockets, right? Once you know how it falls, it's a good idea. An accountant or a finance professional's main job is to place it right. But you should be aware that okay, this is how they have to do the basic account. And before that, what I was saying is, any organization is a different entity, independent of the promoter. If you are starting a business, please get it in your mind that it is not you. The organization has got its own identity. Okay, so when you talk about balance sheet and T, then whatever expense and income that happens into the company, it will start with a clean slate, right? Before the born of the company, there may be some expenses incurred, right? Actually, they say, when is your organization born? Organization is born in the eyes of law when it gets some registration done, right? If you are a sole proprietor concern and if you are opening a shop, then probably once you take a shops and establishment license, that is the start of your business. Or once you open a bank account, that could be the date of incorporation. Or if you start a company, the date of incorporation is the start of the company. But there could be some expenses that you incurred even before starting that company. Like for startups, there's so much of things that you do, right? Those are all called as preliminary expenses. Preliminary and pre-operative expenses. This is before the incorporation or the birth of the company. So it is a good principle for any startup to record those expenses. You might have thinking about starting a company later, but until and unless you do not have the amount of money that you spent, it is difficult to quantify it or get value for that. But lot of startups, they invest a lot of time, right? Though probably you're not spending a lot of money. So it's good attempt to record the hours spent. Or if you have done something, because assuming that he's trying to build a computer, a unique medical device, right? Before forming a company, he has put in a lot of thought, and then you build a prototype even before creating. There's a lot of time spent, less amount of money spent, but you arrive at it. Then you need to value it, right? Then probably you will see what is the replacement cost or what is the cost of development if you do it outside. That's a notional value that if you record it, though it's not money going out now, you have to bring it into your books. So a lot of entrepreneurs fail to record the preliminary and pre-operative expenses. So note it down, and then once the entity is created, it's all about placing the money that you spend in one of these 4 quadrants.
So let's say I buy a server and already started working on it, and now like after 6 months I have started the company. How to bring that into books of accounts are actually
fine. This is a good example. You bought a server on your name,
yeah,
right? But if you want to bring that server into the company's account, because the company is born today,
yeah,
but you have been using it for 6 months.
6 months.
What you can do is, for the last 6 months, you can show server rental expenses. Okay. And today you can value that server at cost and pay that money and get it into company.
Okay.
So that 6 months of rental is also it's getting here, right?
Yes.
And the cost that you are paying to
Buying the company.
the server also comes into it. But where it comes into this 4 quadrant is what is accounting all about.
Yeah.
Okay. So this is something that you need to be aware of. So the left side of a balance sheet is called a liability. Why is it called a liability? It is a new entity, right? Liability is, I am born today, I don't have anything in my pocket. So whoever gives me money, because it's a new entity, I have to give it back to them at that point of time. So it is a liability for this entity. So the left side is called liability. Whichever expenditure that the company has to return back is recorded on the left side of the balance sheet. These days the format is changing. Okay, it's no longer T. Some people present it vertically, whatever it is, but the heads will be different. For a common man to understand, this is an easy classification. Okay. So left side is liability. You record all the items that you are liable to return back. And then right side is asset. Okay. What is an asset?
It's ours, like what we give it.
It's owned by, or physical or tangible asset owned by the company.
Which brings value to the company.
Okay. There will be decisions that you need to make, whether it is an asset or it is an expenditure at times, right? Those are the decisions that finance people take. So you'll get to know about it. And then on the profit and loss account to the left side is an expenditure. On the balance sheet, you call it a liability, right? In a profit and loss account, it's an expenditure. Liability is something you have to return back at some point of time. Expenditure is incurred. Okay.
Income.
And the right side is income. So whatever money that this entity has earned, very important. If you borrow, where will that come?
Liability.
It's a liability. If the company is earning, where it will come? In income, right? But in the process, if you make a profit, what is profit?
Profit.
Income
Hmm?
expenditure.
Profit is income.
Income minus expenditure.
Income and expenditure, right? So you have sold some goods, you show it as income. Whatever is the cost of sales, which is material you produced, the labor that you produced, the marketing expenditure, all this is an expenditure. If you have excess of income over expenditure, it is profit. If you have excess of expenditure over income, it is loss. Depending on whether it is a profit or loss, that is carried forward towards to balance sheet.
Balance sheet.
If it is profit, it is added to the owner's income. If it is loss, it gets deleted from the owner's income. Who is the owner of this company? The company is individual. The owner is always a shareholder. Right? Where does shareholder money come in? In balance sheet. Where does it come in? Which side?
Capital asset.
Which side?
Asset.
Asset. Why?
Liability.
Oh.
It need to be returned.
See, if it is supposed to be paid, so it can be like that.
Company is born with nothing,
Yeah,
right?
liable.
So someone has given you money. So the money has given, so it is a liability.
Right.
So in a shareholder on the liability, if there is profit,
Asset for you, for company it is liability. You're not in your perception. Company.
please ask what's the question.
So I was thinking if capital is an asset, no, like for the company, if it's getting a capital, it is an asset, no, you utilize for its work. So why does this relate to liability?
Yeah, okay. Now assuming the company is a new entity, someone has given money. You are born. I gave you money. Okay. With what intention I gave you money is important. Because on the day you were born, I was so happy. I'm your uncle. I gave you a gold chain. It's a gift. I don't want you to return back.
That's an asset. That's an asset.
No. It is still
Gift.
gift. It's gift, right? What you do with that gift is a different thing.
Okay.
Now let me give you an example here. The funding things that we talk about, there is something called as grant,
Grant. Yeah.
right? Government gives you a grant. It is not expecting you to pay back. It gives you money, right? Zero expectation. So you receive a grant. Where do you account for? It's an income to you.
Income.
Yeah, it's an income.
Income. Yeah.
You need not repay back.
But
That will go to capital.
no, it's a conditional thing.
Yeah, till it is, if there are any conditions to it, then if you have to return back to someone, then it is a liability to a company. Capital is something that is capital is also a liability to a company.
Can be pulled by dignity.
The money that is needed to start a company always is on the liability side of a balance sheet. Because someone is giving you money, and if they want it back, you have to return it. So the company gives an or an acknowledgement that I will return you this money. Right? So if someone is giving you without asking for any return, then that is an income. You need not return back. So it will come under as it will be treated as an income.
Sometimes when government gives grant, they ask you to buy at least 70% of the capital equipment. Then it goes into assets rate.
Yeah, that transfer will happen. Okay. So that is one distinction you need to understand. And similarly, expenditure income. What goes as an expense, what goes as an asset. Like for instance, he was saying, you buy a server. Right? Server is what? Expenditure or an asset?
If I buy a virtual server, it's an expense. If it's a physical server, it's going to be an asset.
Good. Why? Explain.
I'm taking the service rendered by someone, and it's going to I don't have any control over it. over the server which I have. So I have to perpetually pay him. That's an expense which I am occurring to me. And when I buy a server, if I don't use that server also, that will be tangible available with me. So that's why I can account it as an asset.
So any money that is going out, and there is some piece of it that is remaining with us, it can either appreciate or depreciate, that is fine.
Yeah.
Then it goes as an asset. Right? Anything that is going out,
And can't.
you cannot claim anything out of it, is an expenditure. Right?
Yeah.
But suppose you bought a physical server, right? It goes into asset, right? But assuming that you buy it for 1 lakh, then do you show a part of it as an expenditure in your profit and loss account?
Depreciation, if I calculate, then I will show it as an expense on top.
Why is depreciation calculated?
Because like maybe the server can work for 6 months or 7 months, or like new technology come, I need to upgrade. At that time I have to reinvest. For that
You have to
point of sake, I have to keep budgeting for a new equipment to come in.
Right.
So that
Because
can be
any asset, it will have a life of its own. Right? Assuming that a computer has a life of 3 years or 5 years. So you are paying X amount of money, you are using it for 5 years. That year usage will go as an expenditure. So there is a depreciation. In accounting standards, what they said is depreciation is something that needs to be accounted as an expenditure. It is not physical money that is going out, but it is your apportioning a cost of your asset towards the service that you have rendered to raise an income. So that is also to be accounted as an expenditure. And why you are doing that? Because at some point of time you have to replace it. And if you have to replace it, all the amount that is being accounted as depreciation can be used it for purchase of new asset. Right? So in an asset, what they'll have is, if you look into a balance sheet again, if you look into the fixed assets, there will be a depreciation schedule.
Yeah.
They will say items bought, depreciation for the year, right? Accumulated depreciation and written down value. The written down value is what will be showing in your balance sheet. And the depreciation will go into your expenditure. Okay. The reserve, whatever is created, will also be visible so that you have to replace it. So this is in a nutshell about the 2 T's. But just this is not sufficient for an entrepreneur. There is another thing that is important, which is cash flow. Right? So let me go back here. So what are the difference between a balance sheet, the financial statements, balance sheet, and a profit and loss account? Profit and loss account is for a period. It could be the current financial period, or for the current month, or last year. Because all incomes arrived during that period and all expenses for that period are accounted, and you arrive at a profit or loss. So profit and loss account is for a period, is what people will always say. Your P&L account for financial year, current financial year, or last financial year. Whereas balance sheet is till date.
From the birth of the company.
Right. So it is more like an accumulation of all the financial transactions of a company can be looked in a balance sheet, and a profit and loss account is for a particular period. Like probably yesterday you might have heard, if you go to a doctor, he will look at your pulse, he will look at your diagnostic reports and all that stuff to ascertain what is your health, and he'll also look at you physically, right? Similarly, the bankers, investors, shareholders will look at your financial statements. They'll ask for your profit and loss account. They'll ask for your balance sheet. And if you are going to an investor for any fund, they'll ask for your cash flow. And then They will validate whatever you are saying with the numbers that are being recorded and then come to a decision. Right? I evaluate a lot of pitches in the startup scenario, but also on the investments we evaluate. In the pep talk, they say so and so, so and so. Then we say, okay, share your projections for the next 5 years. They'll share projections. Then we'll ask for, give us your past 3 financial statements. So we look at the history, their spending pattern, what they are doing, and then try to see whether the projections are correct or not. We then compare with the industry standards and then arrive at a decision. Similarly, a banker, if you want a loan, he'll ask for this financial statements. An investor, if he wants to invest in this company, he'll ask for your financial statements and he'll run through some metrics, some ratios, probably they might have shared you yesterday, and then arrive whether this is safe, this is giving you the right returns or so. Okay? But cash flow statement is nothing but a statement of inflows and outflows. Like we were talking about an example of when you want to purchase, when you want to make a payment, and when you will get revenue from your customers, right? So it is not just a list of inflow and outflow, but it is broken down by period. It could be quarter, it could be month, it could be on a day-to-day basis also. Okay. So why this is important? If your inflows are matching with outflows, you don't need external money for this. Right? If your inflows are less than your outflows for a quarter, then you need to plan for that when you are raising a capital. Right? So that is called working capital. There are 2 capitals. One is for starting a business, and then second is working capital. By working capital itself, the terminology is you need this money to run this business. There is some money that is required to start a business. That is initial capital. Second is working capital. These 2 are very, very important. Right? So you need to have a grasp of it. So once you are planning your inflows, probably you write down what are the different sources of funds that you want to come into the company, what are the different expenses that are going out of the company, and when they are coming and when you need to go out. If you have this statement before you, then you will know, okay, there is a shortfall in my quarter 1. I need about 1 lakh more because I will not get this money until next quarter. So then you need to decide, how will I get this 1 lakh? Right? 1 lakh, when you need money, how you can raise money? What are the different ways of raising money?
IPO. IPO.
Okay. That is, IPO is what?
Bigger one.
No, IPO is a term, but what happens in an IPO?
You'll pull the amount. Money.
As?
Share. You're open for the equity.
So, you are getting money as an equity.
Equity.
Right? IPO is one way of getting money.
Yeah.
Which is, you know the difference between equity, debt?
Yeah.
Okay. So, one way of getting money is through equity.
And the other is debt.
Other is debt. What is debt?
You will be taking loans.
Which is better, equity or debt?
Based on the condition of the company, if they can make good profits and they can repay back immediately, it's good for the company. Otherwise, when expenses are more than income, equity would be a best option.
So when there is risk and you want to share it with someone,
Yeah.
you will give equity. When the risk is less, you want to keep all profit by yourself, then you look for debt. Right? But there's also a third source, which is what?
Grants.
Grant.
No risk.
No parting away of our income. No worry of paying any interest portion. So that is grants. So these are the three sources of funds. Okay. So if you have the awareness of this, then you will take a right decision whether I need to take an equity,
Grant.
I need to take a debt, or I need to take a grant, right? But again, as I was mentioning, people invite angel investors, people part away with equity, not because it is risky, because it gives them that synergy. If you want to grow fast, if you want to grow big, then the best way is to partner with someone who can take you from this level to that level in shorter span of time than you can do. So it is not just the return or the risk. There are different elements that needs to come into play in this decision making. So as an entrepreneur, if you are aware that, okay, these are the generic things, but is there any other value? So if I am coming and say that, okay, I like your business idea, I want to invest. Okay, why you want to invest is the first question you need to ask. They'll say something. It's okay, I can raise a debt. Why should I part away with my equity? What else you want to bring into this company? To the table, besides the money. Are you going to oversee my operations? Are you going to give me the necessary connections? Are you going to give me new contacts to expand into new markets? Or are you doing any value adds? Or are you giving some stability to my business? These are some things you can ask if you are in a demanding position, right? If you are not in a demanding position, you have to simply sit.
Just go with the ride.
In fact, I want to share an anecdote. When I was trying to sell this company, of course, not sell intentionally, but there were certain situations where I was thinking about something. We were very immature at that point of time. There was an investor who came all the way from Tampa, Florida, along with my associate company. The associate company in the US wanted to acquire, and they were talking to a venture capitalist firm. So both of them came to our office in that Thailand, and it was about 2-3 days of discussion, due diligence, a lot of process before they go ahead. And before the winding up discussion, the venture capital guy sat with us, and he spent last 10-15 minutes. He was saying all good things. Americans, you know, pardon me for my bias. They say all rosy things on your face, but their intention is something different. But I took away something genuine out of the conversation. He asked me, he said, you need to eat a lot of red meat. I said, why, sir? You are a poor bargainer. You are giving up easily for your associates. You really don't know the value that you are bringing to the table. Fight more for your penny. That's what he said, and he left. So it's very important insights, right? We need to know when to bargain, when not to bargain. We might think that we might be in a losing wicket, but that's when you need to interact with people who know this game. They know how to present it the right way, how they add value and say this is an opportunity. If you have ever interacted with Ravi Ishwarapu here, man, he can sell anything to anyone. He finds opportunity in everyone. Every situation he says, why can't we do this? Okay, that's a good compelling story for anyone to get that interest. But sustain the interest is a different ball game, because people will do the evaluation. As the numbers grow, it's a different thing. So these are the 3 important documents, and probably this is a good introduction for dummies to get knowledge of it, right? So let's do a simple exercise. Pick a startup business of your choice. I don't know whether you want to do it individually or you want to do as a group, whichever it is. If you have a startup business, probably do it. Otherwise, pick up something. You can say, okay, I want to start Infosys. I want to start Swiggy. Or I want to start a Sairam parlor. Or I want to start a Daspal hotel. Okay, pick up a business. List items you need to start business with approximate costs, and then categorize the items into different blocks. Right? balance sheet, liability or asset, profit and loss account, income or expenditure, and then make a cash flow. Cash flow is for what you require the money, when you require the money. Inflow, when you will get the return, and try to create a statement, preliminary, right? Try to do that. That will be the all introduction that is needed for you guys to get the grasp of accounting and finance before we touch upon the next fundraising for startups post lunch. So how do you want to do this? Group. So how many groups? Left and right?
Maybe three persons or 2%.
Whatever it is. Or pick up companies, like let's do what companies that you want to pick up.
So I'm setting up a lab at our hub. So I want to do its functionality, how it's going to go.
Right, one lab of our hub. Anyone who wants to join with him in this exercise? No, you both don't want to join. Who wants to join? You want to join? You both. You three. Fine. Okay. What idea you want to pick up? Swiggy, Geetham College, or your soap business, or huh? Tea time. Very good. So tea time. Who else? You both are doing tea time. Anyone else joining with tea time?
Okay.
You want to become an MP?
Oh, yeah.
So tea time. So what about this blog?
Anything?
Pick up something.
Go with your business.
Viveda itself. Fine. Viveda, you both are doing, or you want to join them?
It's okay. Anything.
Yeah. What about you two, sir?
His own business. My own startup.
Fine. So we have 4 business startups that are coming up. Let's take about 10 minutes where you can list down. It will not be exhaustive, right? Just a basic understanding. If you are putting it right, that is fine. So put down 2 T's and another statement, inflows, outflows, break it down by quarter 1, quarter 2, quarter 3, quarter 4. So you are planning for a 1 year of fund requirement, and you are planning for the initial capital that you want and how your company will look at the end of 1 year. Right? So 3 statements that are coming out of this exercise. Great. The moment you write it down and present, we can have our lunch.
Yeah. Stopping it.
Form, feedback form. Please fill it now before Kiran starts the session. Before you forget about yesterday and everything. That's okay. You can take somebody's mobile and fill it in because it doesn't ask for any identifiable information.
It's anonymous. So please give a honest feedback.
24 hours access, please.
See, good. ఇందాక మధ్యాహ్నం మీరు గ్రూప్లో లేరు కదా.
So Shruti also is, it's not, she also not there in the group. Shruti, she's not in the group app. She went to wash.
I'm sending it.
Yeah, sure.
Wait, let's go also there. Every time, all of us, after we do the presentation, we're sharing it in the group. So Kushal now, Pavitra now. One more minute, one more minute.
ನಾನು ಅನೌನ್ಸ್ಮೆಂಟ್ ಇస్తున్నాను అనుకున్నాను సార్.
Me too.
So the second one is Nandini, the first one is Pavitra.
It's
Anonymous.
Hey, Rukni, don't let. I'm just trying.
Okay. So fundraising for startups. So I think if you refer back to the cash flow statements, we have broken down our requirement of funds over a period of time, right? So the time is an important parameter that we all need to be aware of. Similarly, for a startup, it goes through a different stages in a startup. So let's first try to understand what are the different stages of a startup. So the first stage is ideation and pre-seed stage. This is when you incubate ideas. You think about whether this is right or wrong. Second stage is validation. Third stage is
Early traction.
early traction. This is when
You have minimalistic customers or like
you will test,
target segments basically.
you will try to get your first customers and see some success
Your
there.
customer research.
So then scaling. So there are a lot of tweaking that is done from all these stages. In a lot of situations, our idea when we first conceptualize is different when we actually reach the early traction stage itself.
A lot of pivots will be.
And once you are at a scaling stage, probably it will take an entirely different stage, right? And then you will have an exit stage. Exit stage is where you want to come out of this entity and get profit, make profits. Okay. There is one subtle difference that I want to highlight from the way I look at it. Startup versus any ordinary business. What is the difference between a startup and an ordinary business?
Ordinary business, you have to consistently build the rapport with the customer, and you have to be involved and engaged to run the business, and your involvement is important in that. And whereas in a company or a startup, where you have set guidelines and methodologies to take the company regardless of the person or people who are in the company with this bound rules and regulations actually.
You mean brick and mortar? There is an option to exit in a startup. There is a facility that investors
at particular stages based on the agreement they have. There is an exit route available. In conventional methods, it's very difficult for any company to close. At least takes time, 1 to 3 to 6 months. In this startup, it's easier than conventional method.
No, that has to be the case with any business.
Correct.
Yeah.
I think in traditional business, they'll take more of a calculated risks. The numbers which are there will be, I think it will be predetermined, or it is more, we can perform more math on that. But when it comes to an entrepreneurship or a startup, I think it's like some crazy risk, might or might not, the chances, I think.
So you're separating it by the risk.
Risk.
We can say in layman terms,
In a higher risk,
startup, take risk, become a unicorn, start selling once you reach your whatever the numbers that you receive. In other way, the ordinary business people, they'll strive for everyday livelihood or whatever it is. They have to improve their business, go on improving, do some improvements, and then stay in the market.
So you're saying profitability in a startup is higher, exiting in a startup is easier versus ordinary business?
Ordinary, yeah.
Well, I agree to the first point, not to the second point.
Exit options is there for both.
Both the
but,
businesses,
Yeah,
right.
it's there for both, but
Any
startup
business, the basic rule is a business is a separate entity.
Yeah.
If you go with an assumption, then it has to have its own life, right? Independent of the promoter. So anyone who is not with that mindset will not plan for a continuity. So we are talking an ideal scenario where we are saying a business is a separate entity by itself. And what is the difference between a startup idea and a business idea? Normal business idea is what I am getting at. Risk may be a parameter. The risk and rewards in startups are higher.
Yeah.
But again, why is my question? Why? How can you call this a startup idea and how can you call this a regular business idea? Sir, Srinivas, you were saying something.
Yeah, I'm cheating because this is something that we have been telling people a lot. So for me, there are two big differences that separate a startup from a regular business. One, a startup should have something innovative in there. Without innovation, calling yourself a startup just because you started a business is not really a startup. The second thing is the difference between a regular business and a startup is scalability. Can you go from one store to 10 to 50 to 200 to 1,000? Can you scale from one customer to 500 customers to 100,000 customers? How fast can you grow? Is where I would say the huge difference, because all these other things that you're talking about, exit, is that profitability, and all of those, they're there in startups, they're there in regular businesses also.
Right?
What? Am I right?
Of course.
Okay, thank you.
That's a major difference. You see, startup risk is more because you are bringing in some innovation. The innovation might work, might not work. So the innovation could be on an existing idea. You are adding some feature to an existing idea. Because of that intervention, the scalability of the business is growing, which means the ability to create multiple returns is growing. That's what is a startup idea from a business idea. You say that I want to start a Saira parlor. Cannot be a startup idea. If it is just you are doing something similar to what all other parlors are doing. But if you are doing a cloud kitchen and you are probably having a model where you have small outlets somewhere which can be scalable, and you have a model that can be replicated to all towns and villages, right? That's a startup idea. And how do the promoters make money? The promoters or the investors, why are they looking into startups? Is because they believe the money that they are investing in the startups will give them greater returns than ordinary business, right? Just give me a sense, like how much is good return on a business? Percentage?
20%.
20% is very good. Good or average?
Good.
Good.
So far, anything no loss is a good thing.
It's not worth investing there.
It's not a good.
Perhaps 12%, 12 to 15%.
More than the
So what is a safe return? If you have a retired person in your family, they look for safety, right? Where do they invest?
FDs.
Yeah,
FDs.
How much banks offer in FDs?
Yeah, 78%.
6 to 8% or
6 to
whatever.
8%.
Senior citizen,
Yeah.
they get a 0.5%. So that is the normal rate of return.
Yeah.
But someone investing in a startup, how much they expect?
10x, 50x.
10x, 50x, 100x, right? How? That does it mean that the company they are investing, by the time they make money, are they making so much profits? No, right? So if you look into all the deals that happened over the last 5-10 years, very few companies that are valued are making profits. They're not even at a break-even point. They're burning huge cash. They're loss-making units. But how come the investors are making money?
With projections.
For the potential that they can achieve.
same happened with Zomato also.
Yes, you name it. Swiggy, Zomato, Byju's, whatever it is.
What happens, the irony of the game is like every year they come with a loss. The very next day they'll say we are raising
Yeah.
seed funds, we haven't grown. So we come to know that calculation of unit economics, the projections after 5 years, the long run, everything will be compensated.
Yeah.
That's
So
what you said, 50x, 100x they'll get.
the funda is similar. What they are doing is, though they are loss-making units, they are having a captive customers.
Yeah.
And they believe that these captive customers can be leveraged and lot of revenue can be generated from these captive customers. That's what they try to project. And who is doing all this? These are all the venture capitalists guys. They come in, they come up with lot of targets. They say, okay, my customer base is 1 million. In the next 3 years, I will take it to 10 million. I am present in Asia Pacific. I will expand to global. Okay, and they have some metrics. As I told you earlier, anything that you cannot measure cannot be improved. So they come up with unique metrics and they say this is how we are improving. Profitability, they may be a loss-making unit, that's not a problem. But they say these metrics are very important and because of which my company's value is so much. So get into your mind that making profits is not the only way you make money. You have to create wealth. And a shareholder can create wealth even though he is not making profit, provided he is adding something. If it is tangible, obviously there is tangible wealth. But there is lot of intangible wealth which is adding, which is called as goodwill, which is called as customers, regularly serviced customers, the market access. These are some of the things that will give a value to a company, right? So another major way of looking at a startup is something that people start, run, take it to certain point of time and exit. So there are a lot of people who have interest in participation and all these investors make money. Okay, so a lot of startup ideas need to have an exit plan. That is very important. I am a 100% owner now, but at some point of time, I am not the 100% owner. But I still have a lot of wealth. Like if you look at the wealth of Reliance shareholders, how much they owe? They don't have major, they are not major or they don't have more than 51% share in any company. They are probably hold a sizable chunk because it is distributed among public. But they have a controlling interest in the company and management interest in the company. But their wealth has accumulated. So a startup has to have some innovative idea. A startup has to have the ability to scale and bring in multi-X revenue and profits. And it should also have an exit option for investors. These, as per me, is how I evaluate any startup ideas. Otherwise, I say it's a normal business, fine. There's no harm in it. But as an investor, my interest is not in that such sort of a thing. I am only looking at a venture that will give me 300% or 400% or 1000% return in 3 to 5 years of time. That is what any startup investor will look at. I'm talking about an angel investor. VC investor, they look at multiple types. Why? Because they know that if they invest in 10 companies, the chances of that one person become successful itself is less. So the risk is very high, right? So that's how they make compensate money. At the end of the day, they probably also make 100% or a 200% return, not more than that. So these stages are very important. When you are planning a startup, please try to break your growth or the stages of your journey as per these stages. So at each stage, it is important for you to understand when to raise money and from whom to raise money. When to raise money, how you will know?
With the cash in, cash out.
With the cash flow statement, right? Or a fund flow statement. You will know when there is a shortfall, when there is more fund requirement for you, then the outflow, that is when you need money in, right? But how do you need that money is another important thing you need to understand. Whether you want in the form of equity, you want in the form of debt, or you want in the form of grant. So these are the important elements. So in idea and pre-seed stage, what do you need this money for and how do you raise money is important. Ideally, bootstrapping, self-financing, right? You raise from, when you exhaust first point, you go to friends and family. And then you go to business plan or pitching events. But if you ask me now, even though you have your own money, do this stage. First burn your money because it will not give you ownership. The money that is given to you for your pocket money to buy an expensive thing or for an international tour, invest in something because you need to feel that, okay, I'm losing that opportunity. That's when you give that 100% extra. That is bootstrapping and self-financing. And then you have to raise money by convincing your friends and family to give money, right? Not everyone will give you out of love and affection. Though that is their cornerstone, they want you to do good. But a friend and a family who asks you what you are going to do with this money, when are you going to return this money, how are you going to return this money, are your true friends and family. Because they are not giving purely because of affection, but they are giving out of affection, but want you to think and succeed in your venture. So go through that exercise, very important because you get to know those questions. You need to prepare answers for that. And then you go to business plan and pitching events. These are unknown people like us who will judge, will ask you questions. If you say that, okay, your idea is good, then that's an idea validation, right? And then you get into it. Then there is a validation. In a validation phase, when you put in the idea and you have done your initial thing, better come to an incubation center like this, right? Because there are a lot of experienced people here, you interact with a lot of people. You probably have opportunities to connect with government. You'll also connect with angel investors and crowdfunding. You know what crowdfunding is?
Yes, sir.
Yes, which is nothing but your angel investor is collecting the entire chunk from one or two investors. Crowdfunding is making that investment into small tiny pieces and collecting from a lot of people. Okay, so these are the different set of things. Why you do that is, again, there's a reason why people do that. But if you have to remember that compliance, the decision again, do you want to do it the fair way or not? If you want to do a fair way, then you have to structure the organization in such a way that you can access funds from more number of people. There's a difference between a sole proprietor, right, and a private company, public limited company, partnership, limited liability companies. Everything is framed to attract certain set of investors. Why the government is doing it? Because government believes that a structure is framed so that the investor's interest is protected. So if you want to raise from lot of people, then you need to go and ask the chartered accountant or the company secretary, sir, I want to start a company wherein I want to raise money from 100 people. Suggest me what company that I need to start. If you don't give him the right thing, he will only assume something and probably suggest you something, and then you cannot blame that my chartered accountant or a company secretary gave me wrong advice.
After the question can always steal.
Yes. So you need to be aware of it. So these are the validation stage. These are the suggested things. You go to an incubator, government loan schemes, angel investors, crowdfunding. The reason why we say that you go to an incubator or a government loan scheme, angel investor or a crowdfunding is primarily because most of these people have your interest at heart. Okay, incubators, they are here not to make a lot of money. They are here to support the ventures grow because they believe they can add a lot of value to the society and the economy. So they want you to flourish. Otherwise, who will give you a 2,500 rupees seat here? An air-conditioned seat. It doesn't make any sense, right? Similarly, why does government give loans or grants? They are giving you money at your hand. Go and experiment with your ideas. You flourish because you can generate a lot of employment and you can become a big company. So their intention is not to snatch away your business. Similarly, an angel investor, though he needs for multiple returns of your business, they are called angel investors, right? They are like to guide you. They don't want to take away your business, but support you. And then crowdfunding, because you are collecting from a lot of people. I need 1 lakh. I collect from her. She can come and then take over my money or exercise a lot of pressure. But if I split it into 5,000 and spread it across the room, 5,000 is a small thing for each one of you. You probably last you to 2-3 times and then you forget it, right? There'll be less interference in my business. You can raise more money by making it into small chunks and not lose control. So that's why people do it. And the IPOs and all this is built on that funda. You collect a lot amount of money where the individual's interest is so small, so they are happy with the return they get. They don't want to interfere in your business. So you need to know that. And then early traction. This is when you get traction and you know that the idea is working. You want to grow. This can happen in a startup stage, right? And assume that you are in a college. You do not have a lot of experience in handling bigger organizations, right? Handling failure is at sometimes easy, but handling success is also very, very difficult at times, right? So you think that everything I do will work, and people have gone for a toss. So handling or scaling up business requires a different set of skills, different set of approach to business, right? That is when you need the big boys to come in, who bring in a lot of expertise. So the venture capital funds, and here the fund requirement is also heavy, right? And then banks and non-banking financial companies and venture debt funds. When you talk about venture capital funds and a debt fund, it's a different thing. Either you give them equity or you give them loan. And then scaling. This is like you want to grow from your turnover from X to 10X. Right? You definitely need venture capitals because it calls for a lot of money and quick access to markets, quick access to talent. Right? So a lot of venture capitalists, what they do, and this I can share you with my experience. When I built the company in 2005, I ran it till 2011, right? In 2007 and 8, there was one first intervention when I was asked to come on the board. I was an entrepreneur I built everything brick and mortar along with my friends. And the first question that I asked is, okay, I'm willing to join, but will I have the freedom to focus? That was the slogan of my company. So will you give me the freedom to operate this company the way I want to? They said, that's the reason why we are taking you. I said, man, great. And then in 2010 and 11, I could see that I was hardly doing anything to my choice. And I didn't fault at that point of time. The reason why I was not able to do things at that point of time is because I lacked the ability. I had the ability to start and run an organization from Vizag to grow it to a certain stage. I learned the way to operate multi-center operations in Calcutta, Siliguri, and then probably manage operations with Salt Lake City, Tampa, Florida, New York City. But again, when it calls for dealing with bigger clients, bigger scale of operations, my expertise and my exposure was not sufficient. And plus the important differentiator was, for me, that organization was like a baby. I had that parental attachment. I had parental attachment towards my people. It was very important that the people who were there from the earlier days be recognized and rewarded. When I couldn't see the people who were there with me not being giving the right promotions, and we got someone externally paying them 3x, 4x salary, I got frustrated. I felt the organization is not doing good. But I didn't understand the point that they didn't have the ability to take the organization to the next level. So obviously at that point of time, whoever came in with money, their mandate is to grow the company from X turnover to 10x turnover. That should happen. If it requires the founder to be fired, they'll fire. They'll replace someone. They're not people-centric. They are growth-centric. And that is needed for any organization to grow. There are few companies who will not think otherwise, but there are few people who will know it and pass over the mantle. Like Narayan Murthy and all those people. They built leaders. They know when to hand over the mantle to the next one. In fact, one of the famous things that I like and admire about Narayan Murthy is, he says that I'm not the most intelligent person in my company, but my job is to hire the most intelligent person and create competition for it. That was his job. He did it. And then Infosys is not just stuck on Narayan Murthy there. It's now its own company having a recognition across the globe. So that's what succession planning is all about. So scaling requires a separate thing, and we need venture capital funds and private equity and investment funds.
So by the time you scale up to that level, so your voice will be down, right?
Obviously, your control will be less. But again, if your mindset is, I want to make money, I want this company to grow. Even today, I'll say that, okay, that company, I am the founder. Right? Had I stayed with that company, if I had held my equity instead of divesting, probably I would have made a lot of money. Or may not, because I didn't have the capability to run it to that stage. Right? So that happens. That's the risk but it gave me a lot of time to do a lot of other things. So that's what the trade-off is.
What do you mean by that, lot of other things?
I mean, I came out of the company, I made some X money, and then I started my own ventures as a venture. So there's an opportunity cost and there is something ROI that I got instead of staying there, right? So that's what matters. So if you're scaling, you look for this sort of people. So when to raise money and from whom is something that you need to be aware of in startups. And exit options is mergers and acquisitions or IPOs, that's what people say. What they are doing is breaking it to small portions and giving it to retail investors. And they do valuations, fancy valuations. They make money. And they do a stock market game. There is also an option of selling shares again. There are also buyback options, which is another route of exiting for the companies. So now, when and where we got idea. Now how? What are the different things? So grant, debt, equity and equity. These are the three ways you can get money for your need. Be it for pre-stage or be it for an early stage, be it for a growth, be it for scaling, be it for exit. So depending on that, you decide which is most suited. Obviously, for anyone, grant is the best. right? But no one will give you so much of grant that you can make profit while other person is donating. That can happen in certain situations, which is social entrepreneurship. You are running a charitable organization, right? Charitable organizations, motive is not to make profits, right? There is something called as a Section 8 companies. So for them, the business model itself is collect grants and you generate revenue, you generate employment, make it a sustainable thing. Akshay Patra, right? They collect money through donations. It's always grants. Plus they also have a sales because self-sufficiency is the norm of the day. They also sell meals. They probably give it at 750 rupees or 650 rupees a meal. Probably the one that they're giving to KGH and all that. They charge only the basic thing. Quality meal that is made available because all other things are funded in the form of grants. So that's one thing you look at it. Debt is what? It's a loan again.
I have a query here.
Yeah.
Grants they're giving it. There are some organizations where they are giving the grants but not expecting anything from the students or the startups. They are being funded, I understand, from the central government, and they are not expecting anything. What is the fund?
Because they are looking for the growth that brings into the economy.
Because one of our students has got a fund of 5 lakhs under Delhi, Nidhi Prayas. So he got a fund for space food that he will be making and wrapped with mutton. He got a fund of 5 lakhs. He's doing it, the research. And the point is like, they will not be, he will have normal meetings like how much it has been done and what has been done. Even though he was failed to do so, they will not ask. What is the agenda of?
Benefit of doubt.
To encourage entrepreneurs.
Yeah.
I understand, but what do they get?
That's what the government is all about. That is what contribution to the society is, right? Because the chances of success in any new entity.
If that is going, there is another chance as well. My student is very serious on that. He is working for that. What if the funds are misused?
There are.
They will be. That is the reason why there will be some controls, some audits, some agreements that will be executed. They know that okay, there will be failure. When they are giving away fund as a grant, they are not expecting anything. They are just saying that we are behind you to experiment and fail. If you are successful, your growth will be parted with a lot of other people in the society. If you are failing, okay, as a government or as a fund manager, I am going to take the loss, like a family does, right? In a wealthy family, they invest in their children's business. Why do they do that? Though everyone's expectation is to succeed, but they're okay. If they fail, they'll say that, okay, no, I'm not trying to crucify you, right? They say, you got this experience, you learn from this mistakes, go to the next venture. In a similar way, the government or the fund manager is giving you that handholding to experiment. That's what is very important. When you talk about the startup ecosystem, this is what is required. If you look at Startup India, Stand Up India, all this is to encourage and create that ecosystem. Like from my personal experience, when I said that tax-free was the reason why I got into the business, right? So similarly like that. So, and when do you take a debt? I think probably, yeah.
Any idea about like grant from what level to what level in terms of numbers?
Yeah, the next session is all about that. What are the different areas where you can grant? There are certain guidelines. It has to be from the certain industry, or it could be women-based grant, or it's technology-based, or a IoT-based, or a research-based, and there are funds that are earmarked for such and such activity. If you fall under that, you will be eligible for that grant.
So there is a grant is also, suppose government enter into the activity of delivering the end user. Say for example, midday meal government schools. It is run by the government entity. Same activity, some part of the area where the Akshay Patra does, the delivery point is extremely different and very good in the area where the Akshaya Patra operates and government entity that operates middle. So cost of delivering per plate is very high when government entity, because bureaucracy and all this corruption, everything, cost associated with the running the government itself, machinery is a big one. Akshaya Patra does with lower, say lesser cost and by donation from other entities or charitable donations.
Okay.
So cost is very small in running. Government pays some amount of money, but Akshaya Patra does bring lot more fund from other sources. So delivering the end result, delivering the final user up to the plate is very lesser than government what does. So grant is simply makes sense when this kind of institution run this instead of government does the work that otherwise can be done by others.
Yeah, grant is just fostering some new activity where people are not willing to take that path. Then you need some extra help. That is encouragement that is given by the government or from entrepreneurs itself. They do it to encourage that activity. But when we talk about debt, when do you take a debt?
Risk is less and returns are good.
Right?
When you want to scale up your business.
No, you need funds because you want to scale or whatever it is. There is a gap in your inflows and outflows.
When income is more.
When income is more, why do you need
Why do
money?
you
Risk is
Income
less.
is less.
Income is?
When income is less.
So that's when you have fund requirement. But when you have a fund requirement, whether to take money as an equity or take money as a loan is a decision that we have to take, right? So in a debt, you have to pay a fixed amount of fees towards the debt. It is called as an interest, right? In an equity, you are parting away your share. So you are parting away your share of profits and losses also, right? So in a simple words, if you are sure of making profits, you probably do not part away your equity.
Yeah.
If you are not sure about the profits, then probably you think about debt. Is that a good assumption?
No, sir. On the other side, you can see in that way. If you yourself not sure about the profit, how can the party can give you the debt?
Right. No, that's also there. But if you are sure that you are going to make money continuously, then you raise equity. Because that's a fixed cost. You need not give up your ownership. Right? So you are still holding your 100% and you take that whatever interest you pay that goes into your P&L account as an expenditure. And you are making profits. And an expenditure, you see, if an organized, again a little bit of insights into tax. What is tax? You pay tax on your profits. Right? Tax is a percentage of your income. If you are increasing your expenditure, then your tax outflow is less, which means you are paying a portion of tax lesser. That's also a saving. So they are not just looking at interest cost, they are also looking at tax saving there to arrive at the right cost. This is something called as cost of capital. That's the terminology you will encounter. You will calculate that and decide whether an investment is good or a debt is good.
Sir,
yeah.
How long? There must be a limit for the funding in debt channel. So beyond a certain point, it's very difficult to service the debt. So better option will be equity.
Not always. As I told you, if I am sure that my venture is going to make profits, I will always take money as debt because I want to have major chunk of profits.
So obligation will always be there regardless of whether the company running or not. That is always
That is the risk I am taking. That's the risk I am taking because I am sure that my cash flows will support it. But there has to be someone who has to give a debt, right? So when someone is ready to give a debt, I will raise a debt. At some point of time, someone will say that I will not give you debt because you have too much of debt. Then I will go and bargain, okay, I will give you equity. Right? That's when as a lender, they'll look into something called as a debt equity ratio. What is your debt as a percentage of the equity that you are bringing in? And based on that, they give. Yes, sir? Yeah, please. Okay. So, why grant, why debt, and why equity? Grant comes at a zero cost. There is no payment pressure. You will have full control. These are the reasons. Debt, fixed cost. Repayment pressure may be there. Full control. You are not losing your control there. In equity, you are sharing profit and losses. There is no repayment pressure here. Right? Shared control. If you are making someone a partner, he cannot come and ask you, hey, return back my money. You are here partner for both profit and losses. If I make losses, you are also making losses. So I cannot give you any money. The venture, if it makes money, you get money, I get money. Right? So the three critical parameters is cost, repayment pressure, and control. Right? These three probably will make you decide which instrument you need to choose. Whether it is grant, debt, or equity. Now, whom to approach is again probably what we touched. If you are looking for full equity and control, you should go with government grants and funds, or you should raise debts. Debt could be from banks, or there are venture debt funds, or there are revenue-based financing. Revenue-based financing is what we talked about, bill discounting.
Oh, that's what.
Right?
Got it.
You have a future commitment from your clients. That is in the form of your purchase agreements or sale agreements. It's bill discounting. I'll get the payment on the 45th day of me supplying my product. But I need money for the production. So you go to a bank and say, you give me money. So they look at invoice value and they say, okay, you put in 25%, that's what is called as margin money. You put in margin money, the balance money, the banks funds. So now, earlier it was just banks, now the financial market has expanded so much that there are different players who are offering this sort of instruments, right? So if you are looking for full equity and don't want to share control with anyone, you need to look at these avenues. If you are willing to part with an equity and control, how much is again a question, right? How much control you can go? If you are having 51% stake in a company, the 49% people have very limited things in their hand, right? So in a company, there are certain things, percentages, 51, 26, 21. So some sort of percentages. You need to be careful how much you can let go and how much you need to hold. As a strategy, they go in for crowdfunding because everyone will have smaller stakes, so they will not have any interest. They will be scattered. So then you go for crowdfunding, you go for accelerators and incubators. You will have family offices and angel investors. Anyone heard about family offices? So Indian probably capital market system or the business market is different from how it is done in the Western world. Here we have a lot of family run businesses. Tata's itself is a family run business at some point of time. You have Birlas, now it is Ambani's. You have GMR here.
Yeah.
There are a lot of families who have created a lot of wealth. So now as a strategy, what they have done is, we have discussed about investment decisions, right? If a company is making profit, then a decision is whether they should invest in their own company or they should invest elsewhere. So if they can make more money investing in other companies, why not? So each of these families have set up separate family offices to fund the startups, where they need not invest their time. They are just evaluating the ideas. And if they find the merit in the startup entrepreneur, they're saying, okay, we are giving you fund, do it. And mostly it could be a backward integration or forward integration of their line of business. Okay. They know that, okay, I am in the delivery side. If you can become a supplier, instead of me buying from an ex-vendor, I'll get into that business of my vendor. I'll get a stake there. So that business is also growing. And that will help the continuity of my current business. If you know about, a crude example or probably the ground reality is, the film producers now becoming a cartel and taking theatres.
Yeah.
All the theatres in Andhra and Telangana are held by 4 or 5 producers. Because they want best theatres to be available for their films. So instead of they getting into the clutches of the distribution houses or the exhibitors, they themselves have become exhibitors.
Yeah.
So it's a backward integration. So the owners are themselves are running the business, they give them a fixed fee, but they know that okay, if it is coming under their banner, then they'll have these many theatres available for the weekend 3 days. That will give me a lot of business. So it makes business sense.
Heroes becoming producers and producers becoming the theatre
Yeah,
owners.
they can control
Yes,
money.
Any example for family house?
GMR, the local, they have family business. Sangis, a lot of companies will touch base on that. You can just Google it. The Indian family offices supporting startups in India, you'll get a list of it. Okay, and then you know angel investments. Then, if you want to part away, you are okay having less equity and less control, go to the big boys. Corporate venture capitalists, micro VCs or venture capital funds. Now, the primary difference between an angel and a venture capitalist is something that you need to understand. So just put down a parameter to evaluate. What is the difference between an angel and VC? The name itself is angel. The intention is different. A venture capitalist, he looks at the capitals as his main core business, right? So what is the main motive behind a angel and a VC is, VC companies are there to make more return on their investments. That is their core business. Angel investor core business is not focusing on your business. He has some other activity. He just want to make more money on his investment. So he'll allow you to run. He will intervene when you ask. That's what it is. But how they are structured? Angel investors are normally individuals or group of people, whereas venture capital are big entities by themselves. They have a separate finance function, they have separate strategy function, due diligence, whatnot. They come in with a band like an army who is going for a war. They come and add pace to your growth. Investment size, ticket size is what we say. Approximately $25,000 to $100,000 is what angel investors try to invest. And venture capital, it can go to any number. Average is about $7 million. What are the responsibilities and motivations of angel investors and VCs? Angel investors primarily look to financially support and provide advice, more of a mentor sort of a thing. They do not get into real action and run your business. Whereas venture capitalists, they will do everything. They will not hesitate to fire you. They'll say, stay aside. We will run the business. Because ours is a common motive. We want to make 10x money. So whether you run or I run doesn't matter. The company has to make it. They are in that business. So they establish strategic focus, get right talent, and sounding board for CEO. The CEO, you see, decision making is very tough as you handle businesses of bigger size. You need to have someone with whom you need to interact and soundboard and get the right piece of advice. So you need someone in that space who has done it. So VC firms will definitely connect you. Suppose I'm an edtech company. I partnered with a VC now, got some money. Now I want to scale into some other market. Like for example, we are looking into Franco markets, the French speaking markets. So I want, before I invest about $1 million, I'm a little less skeptical about how to do it. Then a VC guy will connect me to someone in that region who has got some insights, and he'll probably talk with me, spend some hour or two to know my strategy, and then say, okay, you tweak this, tweak that, and go ahead, or else you drop it. That soundboarding is something that VCs can provide. And acquiring right talent. Talent is a very big thing. No one is going to work for you for an unsuccessful company and risk their careers. There are some set of people who are going to work only in startups. They come in, work for about 1-2 years, make money and go away. So getting them to work in our startup is not easy until you get the right VC. And then soundboard for your CEO. And stages of funding we talked about earlier, probably a duplication. When you need to go for an angel investor and when you need to go for a venture capital fund. Due diligence is another important aspect. What is due diligence?
Verification.
Verification. No one is going to invest your company without scrutinizing you. They'll rip you apart, both physically as a person and your company as an entity. They'll ask you for every damn document. There was a due diligence, a client due diligence. We were offering a solution for Bank of America. We were doing claims processing for Bank of America. And then there were 6 people who came in to visit our office in that island. And everyone was grilling each of our key employees in our organization. They were looking at my hiring policy, they were looking at my IT policy, they were looking at my security policy, the physical security. One guy was going around the building. Whether is this building a threat? He was asking me, okay, what if tsunami comes? Where will your team work? What if people are not able to come to the office? How are you going to ensure delivery? So that is a client delivery. If an investor is investing, if a Bank of America is investing in my company, I know how it will happen. So, very important for all the startups to maintain proper records, to be compliant on all aspects, right from day one. Because you never know when it will hit. You may lose an opportunity because of some silly thing which probably was not paid attention to. So, if you have to raise funds from the big boys, be sure to be compliant to the core. If you are not compliant, have a strong reason why you are not compliant. They're okay, they know that okay, you cannot be 100% compliant. But you probably say that okay, this is the risk of non-compliance, we are aware of it, we did this risk mitigation. That's what you need to tell them. So again, angel investors, they have surplus cash and they are willing to risk. They act as mentors and equity or debt. So there are a lot of angel investor platforms available for startups in India. So probably you can look into it, approach them. All this is available in Google. Okay. You just look for angel investment platforms. There is Chennai Angels, there is Andhra Angels, there is India Angels. A lot of people, good-hearted people who wanted to do good for the community, they come in. They evaluate companies. Yeah, please. I'll share the presentation also. That's not a problem at all. Okay. And again, it's available in the Google too. Because this is probably not an updated thing. You may have a lot of other information available. So, and college alumni network. I think Geetam is doing a good job now bringing together all the alumni. They can also be an investor pool in that. That's what the startup incubation centers and the colleges need to do. Build an angel network within their own alumni and then connect with these ideas because they have more interest in grooming their own fraternity. So these are the set of people that you need to approach on. Venture capital, again in the growth stage, when you know, what do they ask for? They ask for equity normally. Venture capitalists are not interested in giving debts because they're not interested in giving you, they're not satisfied with 10%, 20% stake. But if your product is very good, you can bargain with the venture capitalists on a debt to equity ratio. You can probably ask that, okay, I need this much of money. a portion of which I want in debt because I don't want to part away more than this equity. And then depending on how good you are in bargain, how much depth is there in your startup idea, they might agree with you. Or they may raise it through venture debt funds. So they do that also.
So all that the venture capitalists, not just funding, but they scale up, right?
Yeah.
They take the responsibility of scaling up.
Of course, venture capitalists, they get into the skin of the game.
That's
You see, the difference, one of the major differences in a venture capitalist and an angel investor is, one of the bargaining things is he'll ask about the equity, and along with the equity, he'll ask for a seat in the board. Okay, and then once he gets a seat into a board, he will decide like the controlling interest in the board. Then he will look into the key resources in the company. He will say, okay, I am giving you this money. I want the CEO to be changed. I will bring in my own team. I want the CFO to be so and so person. He will take control of the recruitment decisions and firing decisions. So he is into the game day in and day out. There will be monthly meetings, there will be weekly meetings depending on the requirement, and they'll drive this founder crazy. He will lose sleep for sure, for good reasons. If the CEO has the potential, then it's a good learning. Any pressure situation, any conflict is always for good if you have the ability to spin it the right way. Because a comfortable situation will never allow you to grow at all. It will only help you to become dormant or sleepy. Right? If there is no AC here, probably we would have been thinking otherwise. Because there is an AC and a comfortable seat, even though I am blabbering something, you have all the ability to sleep or take a nap. Right? But if you are put to other things, then it may be challenging. Likewise, an intervention by VC might bring the best of the entrepreneurs. Again, there are so many people, venture capital funds available. These are sector-specific venture capital funds. And earlier, it was difficult for them to understand the Indian psyche, because a lot of venture capital activities happen in the US. So they were used to certain due diligence process. But of late, in the past 10, 15 years, they have dealt with a lot of Indian companies. So they know how the Indian work. So they know what to expect from a startup. So they are more patient. They understand the same. The chances of we getting the right venture capitalists are high, provided you have a good startup idea. Remember the startup idea, the scalability factor. If you say that I want to start a laundromat and call for venture capital fund, you will not get it. You do something innovative that can be scaled, then you can attract the right people. And now, stages of fund. Here I would like to talk about two elements, which is the company valuation and the founder's equity. In the idea stage, there is no money going out. Remember the balance sheet, it is zero. Right? Both assets and liabilities are zero. So the founder's equity is zero. The company's valuation is also zero. It's just idea. But assuming that in the next stage, you are getting a co-founder. Right? Which is you are built from the idea stage, you are going to the next stage. You got a co-founder and you have parted away 40% of equity to your co-founder. But the company is valued at $2,000. Because if there's someone joining in, though you have parted away the equity, which means you are making a profit-making company, you have built some assets sort of a thing. So the value of your 60% is $1,200 now. So earlier you were holding 100% equity, but the company's value is zero. But even though you parted away with 40% of equity, because the company got traction, your 60% is valued at $1,200, which is more than the zero. And then seed funding. This is when you are approaching your angel investors sort of a thing. And there probably of 60% is what you own, 30% or 30% is what you own. You parted away 60% and 10%, 70%. But this 30% is now valued at $50,000. So here you hold about 60%, but it is valued at $1,200. Here, though you hold about 30%, your equity is valued at $1,500. So as and when you part away the equity, if the company's value is growing, the founder's equity will also grow. Right? This is notional value. But if you have seen, after TDP government came into power, heritage stocks went up by 100%.
Yeah.
What changed? Did anything change on that day? No. It's a notional value. They thought that, okay, with these people in power, the company's future may be very good. Probably they have discounted it earlier. They felt that, okay, if the government is not coming in revenue into power, because Andhra Pradesh probably is a major revenue earner, so probably the business may wind up, so the stock is undervalued. Now with the coming into power, it went to 100% more. So again, the prudence of an investor is to know when to exit. Right? If you are not exiting at the right time, then you are losing value. If you want to hold back, then you never know. You may run into, it may become zero. So again, this is the series A, B, C, D. What is this? These are the different rounds of investment coming into the company. Series A is first round of investment, Series B is second round, Series C, Series D. So there are new set of people who are coming into it. The company is valued at every stage, and then depending on that, your equity may go down. If someone is coming in, someone has to part away the equity, right? So everyone will part away the equity. So your share, you will cash out your equity, plus your wealth will also grow. And then when you go to an IPO stage, probably as a co-founder or a promoter stay maybe 2%, 3%. That's fine. He has already liquidated his 98%. He made money, but his 2-3% will be valued more than all the stages of things. So this is the game what startups are looking at. A founder need to look at, or a co-founder need to look at, or a person who is coming in as a venture capitalist or an angel investor need to look at, because their wealth is being maximized at a rate faster than any other business. That's why startups are looked at with so much of goodwill these days from the investor's point of view, but it is not easy. Not every startup is successful. There are many startups that have failed that success. So you need to understand this journey and then understand to stay at till the right time that you can maximize your return. So for entrepreneurs, once you have moved from an ideation stage and you came to a validation stage, try to get connected with an accelerator or an incubator. Because that is when your idea will be validated by a lot of other people who know this game well. Right? It is like a prep school for startups. Colleges which has an incubation center is an ideal thing, but you need to get the right mentors there to expose them to different aspects of the startups. And then, what are these accelerator and incubator run programs? They run for about 8 months or some for 3 months or 6 months, where they really look and they give you knowledge, they ask you to experiment, they then look at results, then they try to mend it and then take you forward. They like handhold you for a few months, so that experience, that interaction, that intervention really helps them to move ahead. So you can probably look at what are the different startup incubators and accelerators that are available in India, and then see which incubator or accelerator is focused in the area that you want to do, and then try to connect with it. It's not an easy to get into there. There will be some evaluation criteria, but at least you will know what to aspire for. And government grants and funds. The next session is all about government grants and funds. Madam, everyone is interested in grants and funds. Okay, so you know what to ask, where to get. She has got a lot of money in her hand to release. Okay. So grants, normally why are grants given by governments? is to encourage and help people to get through the initial stages of startup journey, right? And there is a specific reason why there is a fund granted. Like they say 80% rebate on patent cost is given to companies. Otherwise, no one will go for patent because patent is an expenditure. And any startup will be running low on expenditure, income, money available. So why do they want to go in for patent registration? But patent is very important for a startup to grow because someone will copy the idea. When there is no uniqueness to the idea, your entire business model may falter. So any expenditure that you incur for patents, the government reimburses it. So when you know that, okay, that is fine, because in one of the grant commission that which evaluates grant, one of the criteria is, do you have patents? Have you filed any patents? So that's an important element that one needs to go. And then startup seed fund, this is another special fund that has been constituted by government from certain financial institutions who are focused in certain set of activities. They come in as a seed fund. Seed fund is, seed means in the initial stages when you want to start a company, then the risk will be high, but they have framed a guidelines. They'll probably see, is there an innovation in this? Is there a potential to scale? So what the government is trying to do is, you need not have big pockets, you need not come from wealthy families to become an entrepreneur. If you have a good idea, which can bring in employment, which can bring in a lot of economy growth, then the government is willing to forego money. Even though you fail, that's fine. So this is the ecosystem that the government has started. So when there are things available, you need to just research and find which one is suitable for you. Crowdfunding, as I told you, this is something that you should be aware of. I am yet to ascertain whether it is legal or not in India because of the restrictions in the company structure, but they are still running. Okay, if you want to raise 10 lakhs for an idea, you can go to a crowdfunding platform and say that, okay, please come in with 25,000 chunks and then I'll give you this much equity, it's happening. So go through that process and identify which crowdfunding thing is good. What they do is they skim through your business models and then they put it on the platform, and any investor, small investor, like you know the mutual fund concept, right? Mutual fund is small chunks of money going into a bigger pool and then they invest in. Similarly, crowd funds is small retail investors coming in on a platform. And these are the family offices that I talked about. I believe there are 140 plus family offices in India. This is about 1 year ago, 1.5 years ago, from the data that's available in the public domain. So they are expected to contribute 30% of the startup investments. Okay, and family offices are more patient, primarily because you see how to get good startup ideas. Startup ideas, one way of looking at is you assume that there is a problem. You come up with a problem statement and you find a solution, right? This is based on some assumption. The problem statement itself needs to be validated. But if an industry is saying that this is my problem, I need a solution, then that journey is fast and it's for sure you know that you are getting a customer. So the family offices will probably also come up with the problem statements, which you can focus on, and then build solutions accordingly. So look at it. There is Adani, there is Bharati, there is ATG, there is Capier, there is DLF, there is HDFC, what not. I mean Ray, Sun Foundation. So many companies that are there, family offices. Jindal,
Mahindra.
So you can probably tap onto them if your innovation, your startup idea is related to what these family offices are doing. They probably are the best people to be approached because they can offer you the right guidance and they can also be your first set of customers also, besides investors. And there is someone which is a new crop of entity, micro VCs. VCs is a big boys game. There are small people who are also calling them as micro VCs. This can be in the idea stages itself. There are certain vehicles that are available. There are certain fund managers who are also coming in to help you with small chunks of money. And all this while we are talking about equity and grant, there are also debt funds.
NBFC.
There are funds that are available that can be invested or given to you as a debt. Why do you take? Most of the debt requirement is normally for working capital and or purchase of assets, right? Because asset means there is a value. You are apportioning a portion of it every year. Or working capital, you know the money is coming in for sure. So that's how the debts are given. They look into your future cash flow statement. They'll ask for something called as a debt service coverage ratio or a debt equity ratio and then sanction debt. So there are again different companies who are doing debt for startups. Earlier, no one used to fund for startups because startups, they do not have a history. They only have projections, right? So startups, they have come with a lot of instruments that can be offered for startups also. But again, this is very, very important. Before you approach any investor, they need a proprietary intellectual property. Otherwise, it's not a startup idea itself. If you want to do what the other person is doing with no innovation, don't call it a startup. It's a business. Regular business. It has to have a large market size. So the uniqueness that you are bringing into an existing problem or the intervention that you are adding up should bring in more customers, which means this problem has to be there for a larger market. Then they are also looking at the people to execute this idea into reality. So unique solution, larger market, right team members, very important, with expertise and experience. So in college startups, definitely they do not have the experience, but that's where if you say that I am incubated by AHUB, or I am incubated by Andhra Angels, or I am incubated by Chennai Angels, then the next set of people will show you interest because you have gone through certain process. And it has to have a scalable business model. The idea needs to expand to larger markets, and the management team members should have a model where they can expand this business. There are a lot of businesses that are dependent on the promoters. There are certain promoters who don't want to give up their control. They don't want to train the next generation or the next leaders in the company because they fear that, okay, if I give it up, my relevance will be lost. But the company cannot grow. I mean, one of the things that we ask before investment is introduce to your key resources. We talk to them. We say who handles finance, who handles HR, who handles operations, who handles marketing. If one person says, I do this, I do this, I do this, I do this, then we say fine. Without this person, this business cannot run. Right? There is no succession plan. So one of the first things if I have to invest is I'll find a successor. And that will be the condition that I'll put in. You have to let go this function to X in 3 months. Put a succession plan. Because the organization is at a risk. If anything happens to you, the organization will go to the dogs. So it has to be a scalable business model. By saying scalable, you need to also have the team members and a market size and the processes that can be quickly scaled. And they are not here for lifetime. At the most, they want to stay for 5 years. So if you are not presenting a business model or a profitability statement saying that your money is not going to earn you 10x or 20x within 3 to 5 years, no investor is going to look at you. venture capitalist or an angel investor. So you need to provide an exit strategy for them, and within that stipulated time, you need to show them that return. So this is what investors want. If you know this, then probably all your approach to your funding will change, right? You will know when to approach a fund manager, and then what he expects. So you have to be ready for that. And most importantly, the current valuation should be attractive, right? Otherwise, how will the investor make money? You cannot quote a price wherein the return is very less for him after his intervention. So you need to value it rightly and then go for the investor with all these ingredients for him to accept you. Okay? So this in a nutshell is the different funding options available, when to approach, whom to approach, and how to put use of these funds, and what are the risks that you should be aware of in approaching this set of investors, and what rewards you can expect. Okay? Any questions before I hand over to the next session? 3:30. Ma'am, your 1.5 hour is ready. I guess no questions, right? I'll share the presentation in the group.
Yeah.
So you can. I didn't touch much about the grant, so it's all yours. Okay guys, thank you. Meet you some other time, some other day. Bye. Bye ma'am. Bye. Bye.
Bye, sir. Thank you.
Bye. Nice meeting you. All good?
We can take a break for 5 minutes if that's required. The things that you wanted to learn, do you think they've met, or is there something else you would want the team to also work on and give provided to you? Any other expectation? This is
That is the only thing that we are waiting.
Okay, perfect. So before we start, would love a round of introduction from all of you all, but we'll do it a little different this time. Maybe you can introduce your partner and not yourself, because you've been doing the introductions to every mentee that I'm seeing. So probably just introduce your partner to me in a line or so, and then we can go ahead. Just want to understand what each one of you are doing. Right. So yeah, you can I think start introducing her and vice versa. Whatever you know about their idea, whatever their name and whatever you know about their idea.
Ma'am is from Gita. She's
Her
already
name is
expert.
Ma'am.
I don't know ma'am.
Okay.
Sandhya.
Ma'am's name is Sandhya. She's from Gita. She's already good at finance. She's really good at teaching stuff like finance and stuff. She currently in Gita she's coaching students regarding finance and entrepreneurship.
Okay, perfect. And coming to her, Bhavna is your name. Pavitra. Pavitra is a very good student who is enthusiastic for this entrepreneurship. Like she wants to start her own business, whereas she has some other concern as well, getting a job. So she's kind of doing a job and this. And coming to her idea, she wants to get the no, I know that, but from the banana waste she wants to get the jute or what? Fiber. From fiber she even wants to get the byproducts like for packaging, for any other stuff. She haven't decided yet that, but as of now her idea is this.
Pavitra.
Yeah.
Right. Sir.
My name is Srinivas. I teach finance in Scientific Engineering College. I'm here to learn about venture capital and all ecosystem.
Okay. Can you introduce sir beside you also? Do you know him? Yeah, can you introduce him also?
Do you know about this, the one who is sitting beside you?
Okay.
Yes, I don't know.
No, I can introduce Srinivas.
Okay.
He is Srinivas. He is working in Scientific Engineering College in the finance department. He is teaching finance.
Sorry, I did not ask about his name, but I know he has say self startup that makes the kitchen activity system automated full delivery system. He is here to learn it.
Yeah, now everybody is getting to know each other.
You should say something right from the last thing.
This guy knows about me, this girl knows about me, so I'm saying no.
Next, we can go to next.
I already.
His name is Mahesh. He do health tech startup.
Health tech.
He's from Vietnam.
Okay.
He will be helping with software development for any startups that are in product.
Okay, what is his name?
TiE.
Til. Okay. Okay, next.
My name is Bindu. I'm a co-founder of Avni Organics. It's a retail store where we are trying to connect farmers to urban consumers. He is Uday. He is working in farmer-related staff.
Okay.
Her name is Bindu.
Good technique. Oh, I should not tell about me.
Yeah.
I should tell you.
It's okay. You can tell about yourself or you can tell about her.
Nandini.
Her name is Nandini. She is from Geetham, second year, BTech, CSC.
See, now people started taking guesses.
Okay. And what is her idea about? What is she working on?
She is working on multiple strategies.
She is
Not from natural.
Millet soap,
Millet
foamy
soap.
millet.
Okay, perfect. The last. Him I know. Now I think the last one. Both of you all.
Actually, I know about him.
Okay.
He is Geeta Madhuri. His name is Uday, and he is working on Aushadam.
What is
It's
all?
related to health tech.
Okay. Is it a platform?
Yeah.
Reports and
Both of you all can introduce.
Sir, Nagesh, not sir.
Check together.
Now just both of you all are left. So introduce.
I should tell about him.
Yes.
Kushal. You should tell about Kushal.
Just
Okay, I'll tell about her first of all. Her name is Nandini Krishna. She is currently a student at Geetham University BBA. But I know her and she knows me 7 years before.
okay.
But the thing is that we never met each other. But her brother is a direct student of me. So whatever I give inputs to him, he usually tells to her. And this is the thing how we connected. Both are from same place, Vijayanagaram.
Okay.
More importantly, she is very strong-minded person. More can I say like?
That's I just needed
She's a tomboy.
I just needed name
She's
and
a tomboy.
okay, perfect. Okay. Just name and occupation and what are they building. That is.
She's currently working on a title. The project title is Foaming Delights. It's all about millet-based soaps.
Okay, perfect.
Okay.
It's so weird. We've never done this, no? He's Balamurali Bhaskaran. He's working as a senior venture coach in VDC Geetham.
Okay.
He's my mentor.
Okay. And can you speak about it also?
No, I introduced. Last one left. I'm Kushal. I'm working on a startup related to renewable electricity generation through trains. Yeah, that's it.
Perfect. Alright, so I welcome all of you all to the last session of your entire workshop, which is on grant funding available in India.
Ma'am, yourself, your introduction. You
Yeah. So my name is Bhavna. I work in AHUB. I'm the incubation associate here. I manage a grant program in AHUB, which is the Ignition Grant Program. I have been working in private and university incubators for the past 3 years and managing such programs. These are a couple of things that I can help you with. So if you all remember this and you need help, I can help you, right? So moving ahead, do you all have any idea what a grant is?
No need to read.
No need to read. Perfect. What? Anything else? That's actually the definition of the grant program. But yeah, any other features do you all think?
The money that is given to support your startup.
The money is given to support the startup, correct? Okay. So just, it is true that it is a non-repayable financial award that is given to startups to build their product and services that they have. It is a non-dilutive funding. For example, you don't have to give away equity or a part of your company in shares or as debentures or something. It's not even a loan that you don't have to give it back. Any grant program will have their specific purpose that they cater to. Like there's a grant program that focuses only on social innovation. There's a program that focuses only on tech, only on biotech, right? So different grant programs have their focus, and that is what they invest in. But a VC fund is different. They have a corpus of 10 crore. They can fund a edtech, they can fund something in agriculture, they can fund something in e-commerce. That is, they're open to different things. But a grant is very focused on a certain cause that they have been established for. And there's a proper application process for most of the grants that we see, that you fill an application form, you submit a pitch deck, then you give interviews, and you have 2-3 rounds of certain things, and finally you get shortlisted. So it ends up becoming a longer process in terms of getting the grant funding. Okay? And every grant fund have their criteria. You need to be of certain years old. You need to have a certain amount. You cannot go over certain turnover as your company, right? You need to be of certain industry. So these are certain things that differs from grant program to grant program, which we'll see later in a couple of examples. And the last thing is milestone and reporting. These become a crucial part of a grant program because let's say I'm giving you 10 lakhs, right? I'm not going to give you 10 lakh altogether. I'm going to give you 2 lakhs. You're going to work on it. You're going to submit reports to me. And after that, I'm going to release the next 2 lakhs to you. So it always happens in a milestone basis where you have to report to the grantor and then they give you the money, the next tranche of the money. Just talking about a couple of grants that we have, like if we can segregate, they come under government funds, the corporate funds and the foundation funds. So the government funds are usually provided by the central or the state government, like the Department of Science and Technology, Department of Biotechnology, right? Ignition grant, the one that we have is Department of Science and Technology. We've actually constructed few floors using that fund, and a part of the fund is we're giving it to startups now for them to develop. Foundation grants are basically, there are these foundations, the Bill and Melinda Gates Foundation, TiE Foundation, etc. They focus more on social impact. They focus more on healthcare. They focus more on edtech. They focus environment-wise. So if your product aligns with their focus, their grant funding becomes available to you. And corporate grants are something that these huge giants, Tata, Reliance, all of these folks, Google, Microsoft, Facebook, all of these have their corporate grants where they have their problem statements and they're specific to the industry, and then they support the startups who are working for those problem statement industry. Right? We'll go into one by one of these grants. So these are certain departments of the government that have grant programs. We can't talk about all of this in detail, but most of your ideas will fall in one of these things. Startup India Seed Fund was something that Kiran sir was previously talking about. It's a two different programs they have. One is a 20 lakh grant program and one is a 50 lakh, which is initially invested in a CCD format, later converted into equity. CCD is compulsory convertible debenture. Right now I'm going to give you 50 lakhs because your company has no valuation. But once your company is of the age that it can get valuation, whatever valuation you are at and raising funds, in that valuation, my 50 lakhs, let's say, is worth 5%. So I get 5% of your equity. Or 50 lakhs is worth some debentures. So I'm liable for those debentures, right? So Startup India Seed works in that way. DBT has certain grants that go up to 50 lakhs, 1 crore, 2 crore. DST also similarly. So it depends on the mission statement that each of these departments have and how it aligns with your organization and your idea. MSME also have their grant program. Mostly, I will show you, there is one MSME grant program called PRISM that is also an early stage. So each of these grant programs by the government departments are available in all stages. Like DBT has early stage grant, growth grant, expansion grant. All stages they have different grant programs. But biotechnology is only when your product is related to biotech is when they'll fund you. For example, the soap idea, right? They'll not fund it because it's not related to biotech. What else? Maybe her idea can be funded because it's related to agriculture and sustainability, which is related to biotech. So you'll have to go through these organizations and figure out what their motive is, and then probably align your idea with them. Right? This is how the portals. These are just few portals I've mentioned here for all of you all to know. I will share the presentations here and get access to all of this. But yeah, so when you go through these portals, they have a lot of grants. Some 35 grant programs were mentioned in the Science and Technology Innovation Fund website, right? So you can go through them, open their application, see the criteria and everything, and then apply if you want to. Okay. A couple of general criteria for the government grant. If you're an individual, you don't have a company, you need to be above 18 years old and have Aadhaar card or passport, etc. as as proof of identity. When we talk about a startup, you need to be a LLP or a partnership firm, etc. But for certain grants, you cannot be more than the age of 2 years, more than the age of 5 years. 7 is maximum. If you've crossed 7, they don't even consider you as a startup anymore. So they will, even if you have the greatest idea and it aligns with their mission, they will not fund you because you're not considered as a startup. So make sure as early as possible you apply for these grant programs, because once you cross the age, you can't avail. Another thing is, once you've crossed beyond the turnover, 25 lakhs and 10 CR turnover, depends on again grant program to grant program, you cannot avail funding once you've crossed the turnover. And yeah, the maximum equity, let's say you all are 4 or 5 founders, maximum equity should be in the hands of the founder who's an Indian. So these are very basic things that you will see in each and every government grant program, irrespective of which one you apply for. Okay. A couple more things is idea should have high degree of innovation and the potential for commercialization. Let's say I want to build a watch, a smartwatch. Now there are already hundreds available outside. To prove that my watch is better than somebody else's watch, there has to be an innovation. So government grants want you to build something innovative that is not there in the market already. If it's already there, they will probably not fund you, right? And not just that, they also look at if your product can actually be commercialized, right? For example, you're building something in the space tech. It will take you a long time to commercialize who is your end customer, because space is not something that individuals, buy, right? These are all government things. So when such complex idea come into picture, the government thinks that is it even a scope to commercialize this product? So these are certain things that you have to keep in mind, because they put a lot of emphasis on innovation employment generated, because they have to care about the socio-economic factors when they give the grant program. And yeah, this one I've already mentioned, they should fall under the sector and the industry of the department for biotech, biotechnology, etc. Proposed outcome must be capable of being achieved within a time frame. Any grant program that is given to you will have a certain time frame. 12 months, 18 months, 2 years, something like that. Max is I think 2 years, okay. You have to finish the project. Let's say you promise that you want to build a watch, right? You have to finish the ideation, from the ideation to a prototype or whatever is the end goal of your grant is within the time frame only. It's not like you have the money and you keep building for years and years that you want. It's not going to work that way. You need to build it in the time frame mentioned by the government. IP should lie with the innovator or startup. IP also becomes a very important part of the entire application process. Any grant that we give for, we first look if they can get an IP. If they don't have, if they can get. Because if you can't get an IP, then your idea is worth nothing. If it's already there, you cannot commercialize it to a big extent. So every grant program looks for the startups to have an IP. And it should be in your hands. As in, if you're the applicant of the grant program, the IP should be in your name. Another thing that they see is a competent team with relevant experience. This majorly comes into picture when you're building something in the science and technology part. Yeah, but I was saying the space tech. So we have a space tech startup in our hub. If you look at the board members, if you look at the directors, everybody are from mechanical and electrical background. There's a professor from the background who's been in the system for quite a while. The main founder is a student who's doing his PhD. So it becomes very important when you apply for such background for you to be from that background also. Okay? And the government being the government, focusing on certain factors of socio-economic, these are certain things that they prefer. They are more open to giving it to women, more open to giving it to young entrepreneurs, right? They've given us a criteria that how many people from the ST/SC background have you supported as an incubator. So they really want people from community. They want to help people from those communities also. So if given the preference, the government would choose, let's say your idea and their idea are almost at the same level, they might choose them because they just want to feature it. So, yeah. And if you're a student or an employee, an NOC becomes important. For example, if you have to work on it, your college gives an NOC saying that we have no problem that my student is working on it. We have no problem my employee is working on it. So these are certain things that become important. Okay, some grants require you to, let's say I'm giving you 10 lakh, but I will require you to fund 2.5 from your side, the contribution from your side, because we also want to know that you are not taking the grant money just to build an idea, to prototype and just leave it then and there. We want to see your contribution also, how much you are serious about it, of running a business and taking this idea to commercialization. So a lot of them ask for a matching, all of them ask to match you. If you are giving 10, you also give 10 and then build your product. Some do not, but depending on different grants. So this is the very basic process that every government grant follows. It becomes very important for you to choose the right grant program for yourself. Now the reason being, a grant program, so there was a startup who was working in autonomous robots, okay, that basically move in warehouses, collecting materials, dropping. It had automatic hands attached to himself, which used to take the basket, put it on itself, move around, and everything, right? And they were eyeing for this biotechnology grant, which was of 50 lakh rupees. Now their idea is entirely into robotics and AI, etc. But they're like, we need the money to build a prototype. So they said that our robots can be used in agri warehouses, can be used in farms, etc. And that is how they positioned themselves and applied for the grant program, right? So to an extent, they were pivoting to the agricultural side, which is not advisable in a lot of situations. Just for a grant program is giving you money does not mean you have to pivot your entire idea towards them. right? So you need to become a little more careful because a lot of things come into play. The IP comes into play when you apply for a grant program, and then they want you to finish the things in 12 months itself. So every grant program will come with certain criteria where the founder might lose their control, flexibility over the operations of their. If it aligns, then it's the right program for you. If it doesn't align, it's okay. You don't have to bend your idea. You don't have to pivot your idea just to get the grant program. You can pivot your idea to make profit, but not for this. Is a suggestion that I would personally give. So after you finish choosing the correct grant program for yourself, the proposal has to accommodate these certain criteria. The problem you're solving, how different your problem is from different competitors out there, right? What method will you use to build your product? I'm giving you a 50 lakh grant. What will you do with the 50 lakh? How will you do it? You need to give them breakheads in terms of every 3 months what are you going to do? First 3 months I will do this, I will need this much of money. Next 3 months I will do this, I will need this much of money. So these are certain things you've not even got the grant program, but you still have to plan, and this takes a lot of time. It takes 1.5 months sometimes to just prepare this entire proposal, right? But it's a good activity for you as founders because then you realize where your product is going. The third thing, after you submit it, there's a committee that actually, they review and they do their evaluation and etc. So multiple rounds of certain things happen, and then you finally get the grant, let's say. So it will also happen as I mentioned, in tranches. You'll get few, then after a couple of months you'll get some more money. They will not release all the money together. And one more thing that happens in the grant program, the last milestone, you have to give it from your pocket, and once you submit the final reports, the government will reimburse you the money. So in most of the grant programs, this also happens. The last one is a reimbursement process, that at the end the government will give you money. So those are certain things you have to take care of. We have spoken enough about the advantages. So one more thing is, when you get a grant program from the government, there's a lot of validation you get that, they've received funding from the central government. So it builds some sort of a support, and so people feel positive about investing in you. Let it be a venture capital firm or let it be angel investors. When you show that you've gotten such money in terms of prize or grant, they just become confident in supporting you, right? And when you get a grant program, usually get it through an incubator like us. So once you become a part of the incubator, you get access to a lot of other things. You get the space at a subsidized rate. You get the mentorship. You get access to such workshops, etc. So these are certain advantages of getting, but certain limitations of having or getting the grant and the entire process are such follows that it's a very long process. It takes somewhere between 5 to 6 months from applying to actually getting the money. So you need to plan in advance. Let's say you foresee your business going on ground in the next 7-8 months. So you need to start planning now that, okay, let me start applying for grant programs. Another thing is, all of these grant programs are open on a certain date and then they're closed. They're not open throughout the year. So you have to keep looking at the website again and again, when are they going to open, when are they going to close. So that is some information you have to look for. To an extent, you lose a little bit of freedom in what you're doing because the grant sort of restricts you to use the money for certain things. The grant program that we have, out of the 10 lakh, you can't use more than 4 lakh in outsourcing. You can't use more than 4 lakhs in raw material and equipment. You can't use more than 1 lakh in the travel budget. You can't use more than 1 lakh in patent. So they basically, they don't provide 10 lakhs. इसका मतलब ये नहीं है कि तुम सब कुछ raw material में डाल दो, fabrication में डाल दो. You need to have a very holistic use of the entire money that has been given to you, right? So that was about the grant programs that we have. Moving ahead to the corporate grants. Now the corporate grants are very similar to the government grants, but these are given by companies who are into business making profit, and people who make profit, they will obviously use their money to make profit. That is something that you have to take care of when you're looking at these programs. They end up providing you the financial support, resources, mentorship, etc. But it comes with a cost, right? And that is what we're going to discuss now. So most of these corporate grants that we have, they will either fund you to increase innovation in their own industry. For example, if Apple is given, if let's say Google is giving a grant program, it might be for something that they are also looking for. They are also looking for some, let's say, few years back they must have released a grant program for something like Alexa, right, or something like Siri. They might have looked for certain innovation and they release application that we're looking for some innovation in this criteria which interests them, and that is why they release the grant program. Another reason why they do is a part of the CSR fund, they have been mandated that they have to look after the social responsibility and they keep aside some, but this is a very small amount. They usually end up using CSR for NGOs, etc. They don't give so much into startups. Strategic alignment and market expansion is another thing that they look for. So that's what I'm saying. When you work with a corporate, they will have their own problem statements that, okay, as Tata, if I want to venture into the EV sector, right, and I have a lot of money, but I don't have enough innovations in-house inside my employees or my resources, they will open challenges. They will be like, we need somebody who can work on the battery life. We need somebody who can work on quicker charging station. As a researcher, as an entrepreneur, if you have the idea, you take the money, you work on it for them. They might acquire you, they might just take you inside the company, but their focus is again strategic, that you work for them with your skills and information, and at the end they'll acquire you, give you a hefty amount of money which is enough for you to start your next startup or something. So they have different motives behind why they do release such programs. You have to read about each one of them. So a couple of things are here. The Microsoft, so the Microsoft and the Google and Amazon startup grants, they do not give you any funding, but they will give you credits. They will give you access, like you can go work from the Google head office, or you can work in India or abroad, right? You can get access to their mentorship. Every quarter they do a mentor thing where employees, where they get employees from all over Google to help you with your startup. I mean, that is more than the money they can give you, the expertise, right? But then there's certain, like NASSCOM, we have NASSCOM building here. These have proper funds with themselves. So they will give you funds, they will give you incubation, they will give you mentorship, and they will also give you networking. So you need to see how you can put yourself in this picture. These three again end up giving you funds, and they have their focus areas as well. But yeah, you need to keep one thing in sure when you apply. No, mostly Tata, Intel, they'll have their own problem statements they would want you to work for. So either they will buy or they will help you get customers for the product that you're building. So that is something that also is a very good thing, because in government grants, it does not open door for customers. But in corporate grants, that is possible. They open doors to a lot of clients and customers in the industry. Yeah, these are a couple more grant programs. Okay, so this is one interesting grant program that I've lately known about, which is the WT fund. It is by the founder of Zerodha. This fund is only for entrepreneurs below the age of 25, and it's a non-dilutive funding up to 40 lakhs, if I'm not wrong, that they're doing, sector agnostic. But they have a very competitive process, the application with the pitch tech, because you're dealing with the founder of Zerodha. But this seems like a good opportunity lately for me, because when you talk about the government grants, now there is no grant that can give you money for a software idea. Like very less. Maybe if you are building for health tech and then a software AI, maybe there is in DBT, maybe you'll find. But a random software idea in e-commerce or in any of the other sectors, there is very less grants available for software products. So the reason why such grants become good is because they're fintech, edtech, ready to fund all of these. So I think again, this becomes like a micro VC only. It's just that it's a grant. It's not a equity fund that they have. Yeah. So these are a couple of things that you get in the grant program by the corporates. One thing that I really feel is good for you is the kind of network and opportunity the organization opens for you. Obviously, something, if you are in the AI space, if you are in the technology space, any incubator cannot help you as much as somebody like Google, Amazon, Facebook can help you, right? And they have their programs. So working in-house with them is way more benefit, even if they're not giving you the funding, right? Yeah. But just sitting there and working with the people out there is going to give you a huge growth in terms of your product. And a certain limitations again becomes, so one thing, this thing you have to take care of, because a lot of them want to work on their problem statement, they'll eventually want to buy your IP. The IP will be in your name initially, but then they'll be like, can you sell us the IP, we want to take over the product, if you build that well. But you don't have to worry. So I don't know if you've heard of this company called Ultrahuman. They're into the glucose patch, and a smart ring is what they're developing right now. So the founder, so right now I think the head of technology or somebody made a ring, made a very sophisticated, it was a big ring for managing health, right? How much you're eating, sleeping, walking, breathing, health, heartbeat, etc. And I'll show you the first ring that he made using a grant money. And later he took his product to Ultrahuman. Ultrahuman acquired the product, acquired him, made him the head of technology. And now the ring is this thin. It's just any other metal ring that you wear, because he got the expertise there in Ultrahuman. So I'll show you both the rings, because my previous company had invested in him, given him a grant fund of 10 lakhs, and he changed from this idea to now what he's built is entirely different. It took him 5 years. It took him 5 years from going from that big ring to that entirely small ring, but now each ring is some 25-30,000, some, or maybe more than that, I'm not aware. So that's how these corporate play a good picture. Even if you are, let's say, in ideation of your product and you build a prototype, if a company thinks your prototype is worth being their product, they will take you and let them take you, because they have more resources available at their end. So yeah, that is where it comes. And again, it's a very short-term focus, because only for a couple of months you get these funding from the corporate grants. Moving on to foundational grants, these basically revolve around social impact, right? They have a lot of money and they want to use it for the betterment of people. They work like government, but they're not so tech focused, etc. They're not so employment focused. They're only focused on the impact that your idea has. These are certain organizations. I mean, if you're building in health, education, these become a really good organizations for you. Even to an extent, if you're building in sustainability, right? So then these become a really good support. These are again, so I found this organization that works for poverty and unemployment, the National Institute. It's in Bangalore. So yeah, these are a couple of foundation grants. And I mean, my last advice as somebody who manages grant program, and I meet people from day to day, working in ideation stage, is that a grant funding may be the first amount of fund you ever receive for your idea, right? But it's not the last. So even if you get it, even if you don't get it, do not rely on it. It is just an assistance that maybe you're getting up. If there is no support on the chair, you will still get up, but on your legs, right? So don't rely on the grant funding. It is just one source of fund. If it's coming, it's coming. You build your idea. If it's not coming, it's okay. It's a good thing that it's a free money, but not all ideas can cater to the vision of a grant program, right? So that is when people get too excited thinking that, oh, it's free money, let's get it. The lot of rules and regulation and restrictions which may mean that you might not get the funding, right? So don't rely on it. Even if you get the money, your focus should be to go and raise more capital for your organization, because it won't be enough. Don't think that, oh, that 50 lakhs is all I have to build my business. No, it won't be sufficient. You will need more funds. So think in a bigger way that this is not all I have. I can get more if I've gotten this. So yeah, that's my suggestion. But I'm now open to questions if you have any.
You're going to share this presentation, right?
I will share the presentation.
How do we approach this foundation grants?
So they have their own websites, ma'am. All of these organizations, they have their own websites, and they have their links also in what capacity an entrepreneur, a researcher, a startup can help. So yeah, if you're interested in knowing about each one of them, I would suggest that you go read on their website. If you need more help, then I'm available in the building. You can come connect with me. If you need help in the application, I can help you. But to understand if their want matches what you're serving, go read about. Everything is mentioned. Actually, let me show you. So for example, this is the MSME grant, which is called PRISM, and this is the early stage grant, where if you have an idea and you want to make innovation out of that, I can see things like who can apply, trust areas, everything is mentioned on the page of the program itself. Okay, so this is PRISM is done in 2 phases. Phase 1 is where you get 2 lakh of funding to just, you have an idea. For example, we had this idea of a student wanting to build a automated washing machine, not the ones that we have, but somewhere where you can scan, put your load, it'll clean, give you back the load, right? Send you SMS, you can pay on it. Like how the laundromat used to work before, we used to put coins and everything, now it's gone. But they've seen that it's a need in hostels, in co-living areas, that these things are not available. You need to give your clothes out for laundry. So something like this can help a hostel owner and also the students who are living there. They can access the washing machine easily. So he's applied for this grant because he does not need a lot of money. His idea is just to take that IoT device and put it in the washing machine, right? So to build the IoT device, a 2 lakh fund is enough for him for the first prototype. So that is where it comes. The second phase of PRISM is where you get a 50 lakh grant program, where you go into scaling your idea. You go into testing, validation, right? Any pivot you want to do a little bit here and there. PRISM comes into picture in the second phase there. So they have their forms here, right? Phases, proposal. Okay, let's look at one of the proposals. Yeah. So they mention eligibility, scope, what can be made from this grant, what can't. Okay, and this is the application form. So it's very outdated format. It's this is a PDF one, but you can download a Word format. You need to properly type in, print it, and then give more information to them. Yeah. You'll have to mention cost in detail. How much will you use for patent? How much will you use for fabrication? Project period not more than 18 months. What are the activities that you will do under the project, right? Yeah. So this is how a very basic form looks like. Forms can become more extensive in terms of references and pictures and videos and all of these information that the government agencies ask for.
And when coming to the closed-ended grants that are there, how do we generally get? Because all the time we may not see that grants, we may not sit on the grants like, right?
So my suggestion for you today is, tomorrow, go and read about the different grants available. Just Google it, grant for Agri-Tech. She's in Agri, she's not tech, but grants for agricultural products. And then there will be a lot of organizations giving. Now go read about the organization. What is the eligibility criteria? What exactly are they looking for? Are they looking to take the idea at the end of the program? Or are they looking to just fund and leave it? So read about them, understand what caters to your need and how you can cater to their need, because everybody will have their need. They're not giving money for, even the government will need you to have IP, will need you to have certain things. And if you feel like there are certain programs you can apply for, then you can reach out to me and I can sit with your idea and with your with the grant program and see if it's actually a match. Or if not, I can suggest you something more. Right? So there are because a lot of grants available, I can't go into detail of every grant, but I've given you an overview of how things work. For example, this is a grant where it's for a hardware, science and tech product that you're building. The ring that I was talking to you was given fund from this program only, right? Yeah, here they've given the objective, sector, duration is 18 months, eligibility. Now, so this grant is available across 44 incubation centers in India. So let's say you come here, everything is closed. See, all the incubators have closed it. Almost everybody has closed it. Every program have a different portal, have a different way of putting together information. So this grant is closed everywhere. Nobody has opened it. So if they would have opened it, यहाँ पे open लिखा होता, and then you can go to their website and see their criteria, etc., and then apply. For example, you apply here in KIIT Bhubaneswar, you don't get it, it's okay. You can apply somewhere else also. But certain grant programs are directly managed by the government. If you apply, they reject, then you can't. There's no other government to apply to for. But when incubators come, you can do this. Apply to me. If I reject you, go to some other Nidhi IDPI. They might accept. Right. One example I would want to give is of this company who is basically making a device which so people who cannot see what this device does, if you put a book under their camera and sensor, in whichever language, in whichever numerical, in whichever font it is written in, the device will read everything out. They've built this product. It's also in the Parliament of India. It has been there in the library in the Parliament, where anything that you put under it, for people who can't see, it can read it out loud for you. So it's like an assistive device. It comes under medtech, it comes under health tech, it also comes under social impact. Right? So these are three different criteria that this product caters to. And for a very long time, the founders have been working on grant programs, because there are a lot of social impact grant programs. For more than a year or so, they were just getting grant programs. Right? They did their pilot with a grant program, grant funding. It was, I think, not up until they went on Shark Tank. So 2017 they started, 2023, last year they went to Shark Tank. So 6 years they survived on grant money, because their idea was in alignment with the government, with agencies out there. Then they not just grant money, they were part of a lot of competitions also. There are a lot of competitions that also happen, which I have not yet covered in my presentation, but these competitions also give you cash prize, 5 lakh, 10 lakh. So those also, and those are the direct money they give you. So that you can use wherever you want in your business. So that is something that this organization have done. I will show you I'm not able to open another picture, but can you see how big the ring is? It's like a small phone here, and it has a ring under it. So it was such a big ring, and now I'll show you what they've made into. And now it has become a thin, small band that you can just wear around your finger, right? Earlier it was such a big thing that you had to carry for. And because he got acquired by Ultrahuman for his idea, he ended up going to them, and they have a very big R&D team. It took him 5 years. after he built the design with my previous company, he went to Ultra Human, took him 5 years to do the R&D, and then finally now they've come up with this ring. Now each ring is of 28,491, right? So these are certain things that corporate brands can help you scale growth because they have the resources with them. So yeah, this is just one example that I have from corporate side. But yeah, there are a lot of grants available. Would urge all of you all to, very best thing to do is put your thoughts in ChatGPT. It will only suggest you what you can apply for, what you can't apply for. And then if you need more help, then I'm anyways available. Any other questions from anybody?
So for every grant, everything is separate websites.
Yes, every has a separate website, everything have a more or less different criteria that they're looking for.
Anything that will aggregate all these grants?
There are a couple of links that I showed you here. These links, right?
Okay.
These are certain grants, like again, not all the grant programs are available in these links. Majority you might find here. So you can start by looking at these links here. If not, then you can go to each and every industry that you think is related to you, and then I will share the presentation with Srinivas sir. He can put it in the group for sure. Any other questions? Anything else?
She's telling me under CSR maybe you can try it. Well, then we have lots of big business people.
Hello.
Is there any way we can start? For social impact. No, maybe if I'm started and I go there, maybe say somebody like
Actually, the easier way would be to go through the commissioner or the collector. Because you know them and you have contact with them. You will be there in a word to, because the easiest I feel are the PSUs.
Can you please resume me or
They
this?
have CSR. They did not follow the law last time during COVID. So one of the things that they did during COVID is, can you hear me? So
Okay, can I
the PM started this PM care stuff. And private and public sector companies went and dumped a lot of money into PM care stuff. The CSR Act, the law says you're supposed to use the funds in your local area. It is not for state government. You can't use the chief minister in the department. You can't use the prime minister in the department. They are not supposed to give it to the prime minister. And it's not even given to the prime minister, it's given to the PSA. Which nobody knows what happened to them. But
finish with environment?
these people have come back, or hopefully have come back to this. If you go and look at, talk to some of these companies,